इससे हमारा मुस्तकबिल भी और इससे हम फ़ायदा भी ले रहे हैं।
तकरीबन 20,000 स्क्वायर किलोमीटर लैंड जो है वो अबंडेंट पड़ी है, जिस पे कुछ भी एग्रीकल्चर टेक्निकल तरीके से नहीं हो रही।
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think they're getting very close, and I want it to happen, and I believe that they're getting very close to a deal. Yeah.
And you'll support it? You'll sign
I will, absolutely. Ask me that in a number of weeks from now. They should be looking at all of this fraud. This is not civil. He thought it was civil. This is not civil. This is criminal stuff. This is very bad criminal stuff.
The President of the United States, and of course, this important trip to Georgia, I believe it is tomorrow, in support of two senators. As we've had a wonderful show, Benma Correa, Nora Robini, now we extend it with Stephanie Baker. She's a Bloomberg senior writer. She is definitive on the finances of the Trump administration, and particularly the focus on Mr. Manafort. Before I get to Mr. Manafort, Stephanie Baker, I've got to ask about Mr. Barr. He's not going to get a pardon. Is he going to get a love note saying you're not invited to the Christmas party?
Yeah, I mean, he was asked whether or not, he had confidence in Barr, and he said, ask me in a few weeks, keeping us guessing as usual as to what he might do. I mean, it's unclear whether or not he'll move to fire him in the waning days of his administration, but it certainly looks like he's using that as a tool to continue, his narrative that the election's been stolen from him, and, Barr is not doing his job by looking at alleged election fraud, and is quite upset with him for having undercut that in an interview that Barr did with the AP, saying he's seen no fraud so far.
Stephanie, Aaron Blake in the Washington Post writes up today this important idea of if you pardon your family or close people, that could really be litigated. Now, Mr. Manafort, I believe, is a convicted felon. Your thoughts on the pardoning of Flynn or potentially Manafort versus a family that have no criminal offenses?
I've long expected Trump to pardon Manafort, and I'm surprised he hasn't done so far, given how close they were and given all of Manafort's actions, which seems to be, looking for a pardon. So that's one thing. But as you say, pardoning his family members, Ivanka Trump, Jared Kushner, his sons, and then, Rudy Giuliani, that's a whole other case. Rudy Giuliani, of course, has been investigated by federal prosecutors for his role with the Ukraine impeachment inquiry. But and Ivanka Trump as well, I believe, is being investigated. But I think this would be potentially litigated afterwards, particularly if his sons were, pre-pardoned. We're on new territory here in terms of, precedents for pardons don't usually go that far, and I think there would most certainly be challenges to it after the fact.
Stephanie, what is the game plan of President Trump after January? If he's running for re-election, or even, you know, in Georgia, if he's focusing all of his efforts for January, do pardons matter in which way people vote?
I think for his base, you know, they would welcome a pardon for Rudy Giuliani because they view the system as rigged. And, you know, I don't think it would matter for his hardcore supporters. You know, it does look like he's raised over $200 million for his PAC. That gives him enormous power and sway, particularly in red states, as a kind of kingmaker in the Republican Party. So I do think that is what he is focused on, is, you know, perhaps dangling the possibility of him running in 2024, blocking several Republicans who had hopes for the presidency in the next cycle from, you know, gaining momentum, and that he would continue to sort of, you know, push this theory that the election has been stolen from him. But of course, in Georgia, that does seem to be, you know, backfiring on him, that it could suppress turnout of Republican voters and hurt the chances of the Republican Party retaining control of the Senate. So it's a real delicate balancing act. And in Georgia, where he's due to visit this weekend, you know, it's all about turnout. It's a game about turnout. And if Republicans think that the system is rigged, as he keeps saying, they may not show up to vote.
Stephanie, how's it going? I mean, how much funding? It's pretty impressive, the amount of funding, actually, that President Trump has been able to do since the election. Is that because people really believe that the election was rigged?
Yeah, I mean, I think he's been pushing this narrative as a fundraising strategy so that he can keep pushing, you know, both these legal challenges, almost all of which he's lost. I've lost count of how many he's lodged and then lost. And again, as a way to motivate people to continue to donate to his PAC. And as we know, he can control about 70% of that for his own purposes. So this is partly a money-making, you know, strategy for him to continue to push this narrative that he, you know, he had the election stolen from him.
Stephanie, thank you so much for joining us today. You are pardoned. Stephanie Baker with us with Bloomberg News. Right now, with our first word news, never pardonable, Ritika Gupta. Good morning.
Good morning, Tom. President-elect Joe Biden plans to fight the spread of the coronavirus from day one of his administration. In an interview on CNN, he said he would ask Americans to wear masks for the first 100 days he's in office. Biden has also asked Anthony Fauci to stay on as the government's top infectious diseases expert. President Trump is again threatening to veto a defense spending bill unless Congress also strips social media platforms of a key legal shield. Both parties have agreed on the bill, which authorizes military pay raises, amongst other things. The measure is expected to pass despite the president's veto threats. And the first U.S. state to tell residents to stay home to fight the coronavirus is about to do it again. California Governor Gavin Newsom warns that most of the state could be ordered to shelter at home within days. He says he'll order lockdowns on a regional basis once hospitals run short of intensive care beds. California has the fastest increase in infections since the pandemic began. And Brexit negotiations have hit a last-minute snag. Trade talks that were on the verge of a breakthrough descended into a fight between the UK and France. British officials say the European Union turned up with a new set of demands. They aren't saying what those demands are. Global News, 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Thank you so much, Ritika. Now we're just getting some breaking news. ECB officials are said to open a 12-month bond buying extension. So we'll have plenty more, of course, on the impact this could have on some of the periphery bonds. We'll also have a look at what the ECB will decide on dividends. Now, this is something different, but this is, of course, one of the big things that will change the banking sector or not. Coming up, we'll continue tracking COVID-19. Dr. Andrew Pekosh, Johns Hopkins University, Bloomberg School of Public Health professor and virologist. That's coming up shortly. And this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Surveillance. Good morning, everyone. Francine Lacroix in London, Tom Keene in New York. How about a jobs day, single best chart? We do that by going bigger, broader here. The raging debate over inequality, the path of wages, and certainly the path of two Americas, the employed as compared to the population of the nation, the huge expansion of employee to population over decades, and then the rollover beginning 2000 and certainly into the crisis, and then the pandemic plunge and rebound. Carl Riccadonna joins us now, Bloomberg Economics chief U.S. economist. Carl, I look at the chart, and it does speak to the two Americas that are out there. From where you sit, can policymakers actually precisely give aid to the part of America hurting so badly?
Well, monetary policymakers, the Fed in particular, I don't think are too able to specifically target their policies, although they can enact policies like what we saw in the last cycle, running the economy hot, and that type of approach to monetary policy, that certainly does help those specific demographic groups. Fiscal authorities, which really are going to have a much more important role going forward, have much more specific abilities to target certain groups and sectors of the economy through tax policy and redistribution efforts.
The November report reported this morning at 8:30, Mr. Riccadonna, will be pretty good mathematics. It is assumed 30 days from now, in the early days of 2021, there will be much more difficult mathematics. Do you agree?
Absolutely. I hate to be glib in such a critical moment with so much suffering and loss of life, but for the economy, it's a little bit of that Wile E. Coyote moment where we've gone off the cliff but haven't looked down yet in terms of the jobs data. And that's exactly the case in November. We had a big spike in case count and lockdown measures, but that happened later in the month, and it was really the first and second week of the month when the jobs report was tallied. And so really those measures came too late to impact this report. So November should still be a fairly robust jobs report, probably continuing that deceleration we've seen over the last several months, but still very strong results. December, however, will be a very different story.
So, Carl, good morning. What will we see in December?
In December, the possibility is certainly there that we could see a negative payroll print or a double-digit type of payroll print. So all of this recovery, this robust recovery, the halcyon second half of the year is not going to hold up into the December months, given what we already know about unemployment insurance claims starting to wobble, increasing over 2 weeks. And then last week came down, but that was maybe a fluke related to the Thanksgiving holiday. We're going to see other types of high-frequency economic indicators starting to reflect that tightening of the vice grips on economic activity.
Carl,
and I should add to that, as goes December, will go January, February, and March as well. So we're heading to a period where the economy is going to look a lot more like it did in the first quarter of last year.
And Carl, what's so important here is the wage dynamic. It's just understood within modern economics, heaven forbid, we could never have true wage deflation, nominal or real, say like the United Kingdom in the first season of The Crown. Is that the surprise to come, that part of America's suffering sees outright wage deflation?
I don't think it's surprising to see that type of wage deflation. In fact, in the 2007 to 2009 recession, one of the phenomenons that Janet Yellen highlighted at the time was the stickiness of wages, that we didn't see more deflationary forces in the wage dynamics. This time around, I think we are going to see more of that because it was such a severe shock, such a concentrated decline in the economy. Mind you, the recession was a record fast and a record deep recession. So as we think about wage pressures and inflation more broadly, we really have to look no further than the unemployment rate. And as long as we have elevated unemployment, that is going to put downward pressure on wages and also on inflation. There will be pockets, hot spots of wage pressures for specific industries or specific consumer goods, but the dominating factor is going to be the wage trend. And I would argue that unemployment right now is artificially low because so many people have dropped out of the labor force. Once we get vaccination and get to reopening the economy, and that's probably a March, April, May story for next year, we're going to see much more unemployment in the economy, and that's really going to keep that lid on inflation and wage inflation for 2021 and beyond.
Carl, what will be, so once we have a vaccine, let's say, second half of 2021, what sector will actually pick up in terms of hiring and possible, tiny wage growth, given what you've just said?
Well, it's a case of first out and first in accounting here for the labor market. We see the types of jobs that tend to be lower skilled, less benefit jobs, things like retail workers, restaurant workers, bartenders, leisure hospitality. They tend to be very quick to lay off workers and very quick to bring them back. There's more elasticity in that section of the labor market compared to more high-skilled jobs where it's very expensive to lay off and rehire workers. So I think that we have certainly seen layoffs across the economy over the course of the first half of this year, but it's been most concentrated in the service sector and in lower skilled, lower wage portions of the service sector. So that's where the job losses were. That's where the job creation will occur. And so we have to be mindful then, as we get into that period of economic recovery, we'll hear those refrains that we heard back in 2010 and 2011 that we're only creating low quality jobs in the economy, but those were the jobs that were lost, so it's important we rehire in that sector.
Carl, thank you so much. As always, Carl Riccadonna there, Bloomberg Economics Chief U.S. Economist. Now coming up, National Economic Council Director Lawrence Kudlow. That's at 9:30 a.m. in New York, 2:30 p.m. in London. He'll be talking to Jonathan Farrow. This is Bloomberg. we explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Surveillance. I'm Rishika Gupta with your Bloomberg Business Flash. In the UK, car makers reported their lowest November sales in 12 years. Registrations plunged 27% from a year ago. England imposed a 4-week lockdown that shuttered all non-essential stores after the number of coronavirus cases soared. The Trump administration is accusing Facebook of discriminating against American workers. The Justice Department says the social network designated thousands of positions for foreigners with temporary H-1B visas. Facebook disputes the allegations but says it's cooperating with authorities. And shares of China's third largest oil company fell to its biggest weekly loss since the oil crash in March. CNOOC plunged 22%. The Pentagon added the company to a blacklist that exposes firms to heightened scrutiny and potential U.S. sanctions. The move was likely due to the company's role in drilling for oil in the disputed South China Sea. And that is your latest Bloomberg Business Flash. Francine?
Thank you so much, Ritika. Now, as we continue to track the virus, Bloomberg has developed this unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response. And of course, every day we bring insight from experts in public health, infectious disease, and emergency preparedness. Well, joining us today is Dr. Andy Pekosh. He's Johns Hopkins University Bloomberg School of Public Health professor and virologist. Professor Pekosh, thank you for joining us on this Friday. The first country in the West to approve a vaccine was the UK earlier this week. There were questions from Dr. Fauci of the U.S. whether they had been too quick. Your thoughts? That was a little bit walked down afterwards, but your thoughts on that?
Yeah, the data that was submitted to the UK and to the United States FDA are essentially the same sets of data. There was one mitigating factor. I think the FDA wanted to hear the US CDC's recommendations for high priority groups for vaccinations. That meeting was scheduled this week and happened, and that's where we get the U.S. recommendations that healthcare workers and residents communities for the elderly are the high priorities. So the FDA was waiting for that CDC note. They're looking at the same data as the UK, and not that I have a crystal ball, but I imagine that we'll see the same recommendation that the vaccination go forward with Pfizer once the FDA goes through their packet of information.
And how quickly, then, could we see approval in the U.S.? And does a couple of weeks difference actually matter?
The logistics of vaccination are the critical things. Everybody is now organized and set to receive these first batches of the vaccines. It seems like the trucks have their engines on and are all loaded up and just waiting for that FDA approval to happen. So you imagine here in the U.S. that there will be immediately shipments of vaccine to centralized areas that are going to begin their vaccination programs in those high priority groups. Those groups have already been prepared for this. Most of them are medical centers who are used to vaccinating their workers. So plans have all been put in place. Priority groups have been put in place for the logistics of rolling out who gets the vaccine and when. And of course, to plan the initial doses versus the booster doses, because 4 weeks from now, we're going to have twice as many people lining up for vaccines because we're going to have people lining up for the initial dose as well as their booster. And all that takes a lot of planning and organization.
Andrew, we also need to talk a little bit about, of course, the self-isolation period. So the guidelines around that have changed. We've shortened the amount of time. Is it because there's new information about how long it takes to get infected, or is it just to counter quarantine or isolation fatigue?
Well, hopefully it accomplishes both. A lot of data that's come out over the last 6 months has really pointed to sort of the first 7 days after an exposure as being the most critical time that you can spread the virus. If you're not showing symptoms, if you've got a negative test during that period of time, it doesn't seem like 14 days buys us much more in terms of protection from transmission. So the guidelines now are really taking into account, are you getting do you have a negative test? Are you showing any symptoms? And if you have a negative test or you're not showing symptoms, then the isolation period is going down to 10 days. One hopes that that will help relieve some of this pandemic fatigue. One also hopes that it'll increase compliance, because with a shorter period of time that you can self-isolate, people may be more willing to do that, and therefore we'll still be accomplishing our goal, which is minimizing transmission while trying to also minimize the burden that people have in terms of their self-isolation and their inability to work and so on and so forth.
Andrew, what can you tell us about how long the vaccines work? I think that there was the latest information is that one of the Moderna, actually the Moderna vaccine, protects you for at least 4 months.
Yes, exactly. That was exciting news that came out yesterday. We'll be seeing more of this from other vaccine manufacturers. Moderna looked 4 months out of the group that was in their phase 1 clinical trials, the first people that got their vaccine. And they seem to have strong amounts of antibodies in their blood 4 months out. When they compared it to a group of people who were infected with SARS around the same period of time, the vaccine seemed to have even higher amounts of antibodies than those infected individuals. So this is the first real long-term study of the vaccines that have been released, but it's great news. One hopes that the follow-ups with other vaccines are going to show the same thing. So everything is working out really nicely with this vaccine in terms of our expectations for its efficacy and the duration of protection, but we're still monitoring and keeping our eye on those things.
Thank you so much, Andrew Pekosh of Johns Hopkins. Be sure to check out VRUS Go on the Bloomberg for the latest information. Then you can tune into these conversations. Now, coming up next, a lot more on the markets. And of course, don't forget that U.S. jobs report later. This is Bloomberg.
Swells the gap between the rich and poor around the world. There may be no starker case of inequality than Venezuela, where the socialist leader Nicolás Maduro has kept his hold on power by fostering a Darwinian dollarization under quarantine. The nation's mighty oil industry has collapsed. Water, electricity, and gasoline are barely available, and hunger hunts vast portions of the population. 4 out of 5 Venezuelans can't afford a basic food basket last year, according to a research by the main universities. Meanwhile, Caracas neighborhoods have a dozen new delivery services bringing to their doors everything from truffle salmon poke bowls to electronic cigarettes and $50 gluten-free birthday cakes.
Welcome to That's Debatable, an interactive series on today's most pressing issues. This week's resolution, should we stop worrying about national deficits? We'll hear from both sides.
Every deficit is good for someone.
There will be automatic spending cuts if nothing is done.
And we'll get your perspective too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
is desperate for yield. The world is desperate for income.
With vaccines in sight, there is much hope.
We are in the beginning of a new economic and market cycle.
By the end of this month, the market will be very overbought. The breadth will start to narrow.
We still have a lot of bad news to get through over the next quarter or so.
Certainly some support is going to be needed going forward.
This is a time when we should not be worrying about $100 billion here or $100 there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro on this Payrolls Friday, 90 minutes away from a stale November payrolls report. For this market, Tom, it doesn't matter.
I've never heard Carl Riccadonna as I heard him, John Ferro, 15 minutes ago, 20 minutes ago. He said simply, this doesn't matter. And December, he would suggest, could be grim.
December will matter to the economists. Will it matter to the markets, Tom? For the markets, they're looking at the data in the second half of 2021, not 2020.
You know, the blur, John, that we've got today, folks, and John will get to the data here of a market lifting, dollar weaker, and all that. John, this ECB announcement a bit ago is buried, and I'm sorry, it just sets up the theme of extend and pretend into 2021. They're going to extend out bond buying. I mean, forever and ever, it's central banks to the rescue.
The ECB wants you to focus on the duration of the bond buying program and not the size of the package they might announce next week. That's been a big push on the communication side. Next Thursday is the decision. I imagine that will be the focus for them when they communicate with us. For us, Tom, we're all getting used to this idea that central banks will be there for us. We've been conditioned by that all year. And I think the biggest challenge for us all through 2020 was to somehow divorce how you feel about the world around you from your view on financial markets, from your view on where we will be 12 months out. That has been so difficult, and even more so in the past 30 days.
Well, the past 30 days, and we're now getting into December. And, John, you just really wonder in 4 weeks where we'll be. We've got the jobs day today. I know Lisa's going to talk about the stimulus, which seems pretty. Is it certain now, John? Do you read the zeitgeist in Washington that 900 gazillion is certain?
Hopes are increasing. Tom, is that what we say, Lisa?
Yes.
Optimism is building.
That's
down
what
in
Arsenal
Washington,
says.
D.C.
The optimism is building. The chances are increasing. The talks about talks getting more imminent. Look, right now I want to take a look at what you guys have been selling so effectively as stale numbers that don't matter. 8:30 a.m. I'm going to be watching those stale numbers that don't matter. We're going to be getting the U.S. November jobs report. We are expecting to see a bit of a slowdown with 475,000 new jobs added. That's down from 638,000 in the prior month. Again, it doesn't matter because it's not the second half of the month, and that's what everyone wants to see. I want to see the momentum. I also want to see whether there's any structural shift in where the layoffs are coming. 9:50 a.m., National Economic Council Director Larry Kudlow is speaking on Bloomberg Television. He is speaking with somebody who we know very well, one Jonathan Ferro. Very curious to see what he has to say about whether President Trump will back the $908 billion stimulus package. It's being put together by a bipartisan group of senators. Really, we have not heard much. He has just backed McConnell's plan. Really curious to see whether there's any openness to this new plan. 10 a.m., U.S. October factory orders and durable goods orders as follows. Better than expected data in Germany. You see a deceleration in that capital investment, but still looking to that hope of 2021, John, that you're talking about, not so much the misery of 2020.
Well, I tell you, Lisa, it does matter to someone. The payrolls report in 90 minutes' time certainly matters to the policymaker, and I think it matters to the debate that will play out on Capitol Hill, Tom, in the coming weeks and days, and let's hope it's days and not weeks. This is the story at the moment. We have a bipartisan proposal. Within that proposal, there is $160 billion of state and local government aid. Within McConnell's proposal of $510 billion, zero. And that's the story. And I'm trying to work out, and maybe we'll get some clarity later from Larry, Tom, as to whether that is a red line for the White House, state and local government aid.
I mean, we did it with Francine all morning. We don't need to do Brexit now, John, but come on, it's no different than the red lines of fishing rights between France and Netherlands and the United Kingdom. Yes, there are red lines out there, and they've just got to decide what's the political expediency of getting a deal done in a lame duck period. My answer is a lot of people want this done.
Brexit-free zone, I hope, for the next couple of hours right here on Bloomberg TV and radio. Let's get to the price action of this Friday morning. We're set up as follows. I'm going to brush away any suggestion we'll talk about fishing rights on this programme. Futures up 11. We advance 1/3%. We bounce back a bit. Euro-dollar near the highs for the year, 121.66. And Treasury yields bleeding a little bit higher as well, up 2 basis points on 10s to 0.9261%. On the bond market, joining us now, Priya Misra, TD Securities Global Head of Rates Strategy. Priya, the number in about 1 hour and 25 minutes. Does it matter to you?
It does matter. I think I'll be watching the momentum. Clearly, that December number is going to matter more because that's when the COVID restrictions should show up in the data. But our economists do have a much weaker number. And I think this market that's forward-looking, that's pricing in the end of the, the light at the end of the tunnel, if the tunnel is long and, scary because we're heading into a period of weaker economic growth, I think the market, at least the rates market, is not pricing in much of that weakness. The 10-year is almost at 1%. So I think the market's really pricing in this vaccine-fueled recovery, stimulus, where we may have to deal with a lower growth environment and the Fed doing more. So I think you actually do get a reaction in the rates market. If it's anything less than 400, 300,000, and our economists have 200,000, so we're actually going into this number long treasuries.
Priya, I got to make some money here. The kids wanted a 20-foot Christmas tree. So, I broke the bank yesterday. What I want to know, Priya, is do I step in here and buy fixed income, buy bonds, notes, and bills because we've had a nice move in yield and now's the opportunity to look for lower yields later?
I think so, yes. I don't know if it's going to get you your Christmas tree, but I think you have to buy a lot more treasuries just because the extent of rate move I'm looking for is like 20 basis points. Do we get to 75, 80 basis points on the 10-year? So there is a floor. We're just very low, close to zero. But I do think we've sold off in treasuries, pricing in all the good news out there. There is a key Fed meeting coming up, and our view is that they're going to make QE state contingent, and they're going to extend the average maturity of QE purchases. They just kind of have to do it. The market's forcing them to do it. And they've realized that there could be longer term scarring. We still have so much uncertainty about the vaccine. So I think rates have sort of priced in too much of that good news, and we haven't quite priced in that we have a long way to go before that COVID recovery is upon us.
Priya, build a little bit on this idea that the market is forcing the Fed to extend the duration of its purchases. I'm looking right now at a 10-year, 0.926%. Not exactly screaming, we're running away with higher yields that could potentially threaten financial conditions. Why do you think that they're forcing the Fed's hand, and what do bond yields do if they do not confirm the market's expectation?
So I'm going to say the Fed is the only marginal buyer of treasuries right now, particularly in the long end. The front end is so anchored by the Fed because of their FATE policy, because of just inflation being low, that if investors want to be in treasuries, they want to be in that front end. Meanwhile, the U.S. Treasury is issuing a lot of long-dated paper, and that's really only happened in the last few months that they've increased long end coupon sizes significantly. So the market right now is expecting the Fed to do something in December, which is why we're at 1%. If that meeting happens with nothing, I think we're breaking through that 120, 125. Are we at the brink of a taper tantrum? And I think the Fed knows that, which is why we expect them to come in and sort of tell us that they're going to keep conditions accommodative.
Priya, it's away from your remit, but I'm going to go there. Are we back to 2005 and 2006 of the silly season of parsing out every 100th of a basis point of investment grade, high yield, leverage loan yield? I mean, are we back to the silliness of reaching out for yield?
I don't know if you call it silliness, but we are in a very serious reach for yield environment. And the question is sometimes people don't understand the risk they're taking, but they're forced into different alternative assets. Yes, I think I would suggest people should do credit work because default risk is mispriced in certain products. But in the investment grade sector where you're not worried about default risk and you're not worried about interest rates going higher, I think like anything is fair game in terms of how do I get that extra yield? And we're seeing it in people selling volatility at historic lows. People are selling vol, they are taking spread risk, they're taking FX risk. So I think if interest rates are not going to give you that return, you're going to have to go into other products to get that return. And, that's the intended consequence of QE. That's what the portfolio balance channel is. You take duration risk out, the central bank takes duration risk out and force investors into the risk spectrum. And the hope is that that translates somewhere into an economic recovery and then everything makes sense. I mean, there's a big hope in there that you don't see this disconnect between the economy and markets.
We all hope it makes sense in the end. We spent 10 years debating whether it made sense a decade ago, Priya. Thank you. Priya Misra of TD Securities. Long treasuries going into this print, 1 hour and 20 minutes away. High yield spreads yesterday, tight. 385. The tights of the year, 315. Still not there yet, Tom. But the absolute level, and Lisa will speak to this, Tom, the absolute level, we haven't seen these kind of numbers before in many places worldwide.
Go to Lisa. I mean, Lisa, this is your wheelhouse. Come on, Lisa. This is artificial, to say the least.
Well, and artificial because of why, right? Is it because people have confidence in the economy or they believe in a backstop from the Federal Reserve? If you look at the all-in yields, John, 4.45%. That's the average on high-yield bonds. That is a new record low. That is basically what you were getting on investment-grade bonds a couple of years ago. And it raises the question, what does that mean for returns, right? They've got to go lower, but you also have to think you're not getting compensated if some of these companies go belly up. And yet, what are the other options? That's the nut of it. Where else do people go?
Elisa, I think that is the ultimate problem, Tom, that investment grade has become the new risk-free asset for so many people, that high yield has become the new investment grade. Where's junk? Where do you go?
John, I go to Bill Gross telling me a Procter & Gamble dividend looks good.
Yeah,
I mean,
stocks.
I'm sorry.
You start to look at the equity market.
You go to dividend growth and equity. I mean, people may not say they do that. I give mental block. Margaret Patel at Wells Fargo, major credit for this. She's never not admitted she goes to dividend growth when she needs it. Margie
She is
Patel.
wonderful. Margie Patel of Wells. Let's catch up with Margie at some point before
but this
Christmas. We should do that.
Gross once said this. He made worldwide headlines. I'm buying Procter & Gamble's dividend. I'm not saying PG, but, John, I mean, that's where we are in the silly season.
It is the silly season. It gets real in about 1 hour and 20 minutes. Payrolls Friday in the United States of America for the month of November. It's December where the focus is right now. Futures up 10 on the S&P 500. We advance 1/3 of 1%. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
With your First Word News, I'm Ritika Gupta. The Justice Department is in talks about resolving charges against the CFO of Huawei Technologies. It's a long-running dispute that's fueled a clash between the US and China. Canada arrested Meng Wanzhou 2 years ago on a US request, and she's been confined to the city of Vancouver ever since. Dow Jones reports there is talk of a deferred prosecution agreement on violating sanctions against Iran. That would allow Meng to return to China. Joe Biden says he'll ask all Americans to wear a mask for the first 100 days of his administration. The president-elect also told CNN he'll issue a standing order requiring face coverings in federal buildings and interstate transportation. Biden says he thinks all that will lead to significant drops in coronavirus cases. And OPEC and its allies have finally found a compromise on those output cuts. After 5 days of difficult talks, members agreed to gently ease into reducing production next year. Saudi Arabia's energy minister called the process tiring and excruciating. DoorDash has boosted the price range for its IPO and is now seeking to raise $3.1 billion. The biggest U.S. food delivery company is marketing 33 million shares at $90 to $95 apiece. DoorDash is part of a group of consumer-oriented, web-based companies that have IPOs lined up for this month. Airbnb is another one. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Tenemos 3 drones sobrevolando la zona, básicamente por temas de aforo, porque el aforo ahora mismo y la seguridad es lo que más nos preocupa.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
I think they're getting very close, and I want it to happen, and I believe that they're getting very close to a deal. Yeah.
And you'll support it?
I will, absolutely.
The President of the United States on stimulus talks down in Washington, D.C. He will support it, whatever that deal might be. We don't know what that deal might be. We have the McConnell proposal. We have the bipartisan proposal. We'll talk to Kevin Cirilli about that in just a moment. From London and New York this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, live on Bloomberg TV and radio. Counting you down to the payrolls report, 1 hour, 12 minutes away. Here's the price action for you in the equity market. A pullback from all-time highs on the S&P 500. We wake up Friday and add some weight back into the benchmark. Up 11 on the S&P. We advance a third of 1%. Euro dollar. 121.78 is your high for the year. We are just off that level right now, up a quarter of 1%. That is a stronger euro on the session and on the week as well. In the bond market, Tom, this has been a move that's got a lot of attention, up another 2 basis points in today's session. I think the worst week for Treasuries going back to that week where we got that Pfizer news, the second week in November. Yields up and away over the last several days.
Yeah, there's no question about it. The correlation here is pretty apt. I'm also watching weaker dollar. It is there, and Chinese yuan has been stronger this morning. Again, Pacific Rim currencies simply roar. Right now, Kevin Cirilli with us, who's going to have a long weekend. The news flow in Washington is extraordinary. He is our chief Washington correspondent. Kevin, we'll get to the stimulus in a moment. Dave Wasserman stopped me cold last night with his popular vote update. He's really good at parsing all of this stuff and the counties and that over to Cook Political Report. And Mr. Biden is now out front, 7 million votes on the popular vote. Kevin, just to the president's upset, was this even close?
Well, I think it was close in the sense if you look at how Republicans made gains in the House of Representatives which will still be a Democratic majority, but we're waiting to see what happens in Georgia. So I think the diagnostic reports that both parties do after an election cycle are still waiting to be seen. But amongst the Republican donor class and political strategist class, they feel that it was the president's reelection campaign that lost the executive branch while they were able to make significant gains in the other two branches.
Well said. Part of the donor class, Kevin, is a senator from Georgia doing 2,700 trades or something off of his desk on the Senate floor. Does the donor class help these two candidates who are desperate in Georgia? And as part of that, does the president's visit help?
Yes. Look, I mean, this is a deeply conservative state. It did go for Joe Biden, but it also that was the first time that President-elect Joe Biden was able to win Georgia. You have to go back to 1992 when Bill Clinton did it, because this is a deeply conservative state. Now, the question becomes, can Raphael Warnock, the Reverend, as well as John Ossoff, the former journalist, can they mobilize the far-left progressives? You know, there was a brilliant article in the New York Times the other week that really captured quite candidly that this is the type of Democrat, if they are to win in this state and pull off an upset against Senators Loeffler as well as David Perdue, that they would have to be running a campaign much more akin to what we saw down south in previous runoff elections. I would even argue that they'd have to run a campaign more to the right of someone like a Connor Lamb even. So it's a Joe Manchin-esque type of strategy that they're going to have to put forward, and it's very different than trying to attract the Green New Deal folks, who they will need to turn out. So what's going on behind the scenes is the Democrats are trying to figure out, can they really message to the activist crowds in Atlanta, for example, that, look, this is bigger than just a senator, and it's really the fate of the Senate that's at stake. Can they message that to get the centrists?
When you talk about the fate of the Senate, it has to do a lot with the fate of a fiscal support package, and people are looking to the Georgia races as a sort of gauge of popular support or not for a fiscal support package. What is the popular support for this bipartisan bill, and how is that influencing Republicans potentially getting on board?
It's massive. You know, finally, they're not talking that you and I have talked about for weeks. What they're actually doing is rolling up their sleeves and getting to work, Lisa. Yesterday, 3 points. Yesterday, the Joint Economic Committee meeting with some economists, that this is a bipartisan group, talking about much more nuanced ways, going line by line in terms of different types of lending facilities in addition to the central bank that could be created in order to go directly to small businesses and directly to industries, airline, hospitality, tourism, industries that have been really negatively impacted over the past couple of months. Secondly, why this sudden shift? The reason is because Speaker Pelosi is looking at the political tea leaves, and her majority is about to become more slim. So that's put some more, that's given the centrists, and this is the final point I would make, that's given the centrists much more of cards to play in these negotiations. In addition to the Problem Solvers Caucus, a group of bipartisan members on the Hill, in the House, but centrists in both parties, like in the Senate that we've talked about now for a couple of days. Republican centrists are really going to be able to do some wheeling and dealing, so to speak, in not just the lame duck, but the new administration as well.
Yeah. Kevin, some real confusion from our audience listening to this conversation, who hear the words bipartisan proposal and then McConnell proposal. Can it really be bipartisan if the leader of the Senate has a different plan?
It can. And look, I mean, we always say this, but it bears repeating. I mean, for Senate Majority Leader Mitch McConnell to get the Democrats to go from $2.4 trillion down to $908 billion, and let's not forget they started above $3 trillion, is remarkable. And now he's saying, okay, so the Democrats have moved their goalpost into less than $1 trillion, which Republicans like. We've seen Senator John Thune and the likes come out in favor of it. And now what Leader McConnell is doing is saying, let's see if I can get them to go lower.
See you at 5. Kevin, great to catch up, as always. Kevin Cirilli, Bloomberg Chief Washington Correspondent. No stimulus checks in either plans. The plans line up as follows. 510 from Leader McConnell. 908 from the bipartisan proposal. But the key difference is the difference that's really dominated the division in these talks over the last several months, Tom, going all the way back to July. It's state aid, 160 in the bipartisan proposal, agree. And nothing in Leader McConnell's.
I believe the working number is $160 billion for state aid or whatever. The MTA in New York City alone needs, I believe, $12 billion is a working number. That, you know, it's, I guess it just gets something done. That's the way it's going to be.
Well, that's what this conversation is over, though, Lisa, and I think it's absolutely key to be clear about it. The rest of the bill, there are differences elsewhere. I could go through it line by line, but the top line is this disagreement over state aid. Speaker Pelosi's blinked, come in, compromise, whatever you want to call it. But the key difference is still over that one issue.
And that's really the reason why people believe President Trump has not signed off on this and his sort of support behind the McConnell bill, because it's politically perilous for him to come out and allow money to go to state and local governments that he's maligned as being all blue states and not handling the virus and other fiscal issues correctly. I will say, John, how much does the acceleration of the pandemic in some red states affect the discussion to try to get this aid out more quickly?
Will the payrolls report in 1 hour and about 5 minutes move the dial on this conversation? Coming up shortly, Ellen Zentner of Morgan Stanley, the chief U.S. economist for our audience worldwide, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Payrolls Friday. Here's the price action live on Bloomberg TV and radio. Futures just ticking a little bit higher on the S&P. Down yesterday, a mild move lower, up 1/3% this morning. The Nasdaq, another record high in yesterday's session. As I said yesterday, the day ends in a Y. You got a record high, up another 1/3%. The Russell taking a bite out of a weekly loss. The first weekly loss potentially going all the way back to the end of October. We advanced this morning and take a chunk out of that, up 0.75%. Get away from stocks, get to bonds quickly. 2s, 10s, and 30s. The estimate, 460. The payrolls report, 60 minutes away. The range, wide, all the way from negative 100K in our survey, all the way up to north of 700,000. We'll get the view from Morgan Stanley in just a moment. Yields higher, though, up another 2 basis points on a 10-year to 0.9261%. Up on a session, up on the week. The worst week for Treasuries, the biggest pop higher in yields, going all the way back to the second. 21.70 earlier, up 0.2% right now. Euro stronger. How uncomfortable the ECB will be depends on how uncomfortable or comfortable the Chinese policymaker is with the Chinese currency. And today, Euro China just starting to go the other way a little bit. Bit of Chinese currency strength. Let me finish on this, though. Euro sterling, 0.9033. I promised we wouldn't talk about Brexit, Tom. Apparently the talks are getting difficult. Apparently the talks are getting difficult. Bit of new information there for you. Euro sterling with a bit of a tick higher off the back of that headline.
And Chinese renminbi strength against U.S. dollar. I'm going to put it on the terminal at 9% strength in Chinese yuan. That just racing since June, and we see that across the Pacific Rim. Folding all this in has been Chet Naya in all of Morgan Stanley economics. The leadership of Ellen Zettner, their chief U.S. economist, has been extraordinary to try to figure out the ebbs and flows of GDP and how it folds into a pending jobs report early in January of next year. Ms. Zettner joins us this morning. Ellen, by great definition, by discussion, today's jobs report really is a look back. What is the data you see now for the January report? What does December look like?
Yeah, so as we roll forward, I think we continue to see job growth slow here. I think we do still hang on to some net job gains because the economy isn't shut down broadly as we did earlier this year. But certainly the amount of folks coming back to the labor market and absolutely in that service side of the economy it just has to slow further. I mean, it's going to be a difficult winter. We know this. We're married to this idea. We're all disappointed in what the winter is going to look like. But these payroll reports are getting overshadowed by positive news on the vaccine front and the fiscal headlines.
Are we going to see services disinflation stay where it is with a slowdown in the service sector, or do we get back to normal inflation dynamics between services and goods?
Well, those are the two biggest drivers of our inflation forecast for next year. I mean, goods inflation has been driving the numbers this year because the goods side of the economy that has been growing and driving output, that consumer demand for durable goods. But next year, as we roll into next year and activity starts to pick up, as we move further through getting the vaccine rolled out and activity picking up, that services side does come back. And that is the lion's share of consumer demand. It's the lion's share of what drives the price indices. So goods prices decelerating, but services prices pick up. Services prices representing the bulk of the price indices means inflation will be higher next year.
Ellen, everyone's saying that the economy will come back in 2021, and certainly that is consensus, and it's easy to see how that could be the case. But the post-pandemic economy will look quite different in terms of consolidation of companies being stronger and bigger at the top and the smaller companies that have gone out of business. What does that mean longer term for the labor market?
Yeah, so the small businesses are the driver of job growth, and part of the loss of wage bargaining power over time has been the rise of mega companies and company density, and so that is something that when you add that to the other inequities that have been further exposed by COVID on the household side, I think it's a heavy lift that the Democratic Party is going to focus on in terms of that fiscal policy activism that overall tries to raise the labor share of profits. And that has been part of our longer run thesis on why inflation over the long run would be structurally higher. I think that's going to be the focus going forward, not just household inequities, but inequities on the business side as well.
Ellen, we spend a lot of time on programs like this, beating up on the South side. I have to say, let's just take a moment to really talk about one of the calls coming out of this crisis, and that was from you and the team, that this recovery would be quick, this recovery would be sharp, it would look like a V, and that was something we heard from politicians down in Washington, but many people just did not believe. This has been so underappreciated in the same way the equity market record highs are hated. Ellen, what did everyone get wrong? What do we learn from the lesson, and how do we apply it for the months still to come?
Well, I think, you know, for me, there's a story that's missing in that V-shaped recovery. And to me, it's, you know, when you open up from nothing to something, it's a very big jump in activity. And this was not a cyclical downturn. This was a structural downturn. So the way the virus would play out, the way vaccine development would play out, the way the economy opens up, that's what's dictating that V shape in the economy. Where I am still greatly disappointed and where I think there's still a lot of heavy lifting to do is exactly what Chair Powell and the Fed are looking at as well. I'm looking at women's labor force participation rates. I'm looking at the unemployment rate of minority communities, of the unemployment rate of those that are concentrated in low wage paying service sectors that are going to see longer term damage from this. And so I do think that there is a great need and focus on further fiscal support so that these longer term unemployed folks don't leave the labor market altogether. Because if that's the case, then it doesn't matter that we got a V-shaped recovery. It's going to matter that longer run potential growth has been damaged.
So this is important, Ellen. The big call from Morgan Stanley was this V-shaped recovery at the headline level. The complication you're talking about is the disparity beneath. Have we already done sufficient damage that it could take years, maybe even a decade, to recover from what we've experienced, Ellen? Or can we actually do something about it?
No, I think we can do something about it. I mean, the biggest way that you can help those underlying components of the labor market is by running a tight labor market, meaning a hot economy, very easy monetary policy accommodation, targeted fiscal policies right up front. More is clearly needed, and we expect more to come. But those kinds of things can get you as tight of a labor market, so as low of an unemployment rate as possible, as quickly as possible. And we do think by the end of 2022, with that kind of focus, we can push the unemployment rate back down to around 4%, so getting close to the Fed's goal of maximum employment. But without that, you know, I think the literature, there's a broad body of literature that shows that if you have a sluggish recovery after a deep downturn, that you do see permanent scarring to the economy. So I can't stress enough that we need to be doing all of this upfront now in order to push the unemployment rate down as quickly as possible and get those folks back reattached to the labor market and reemployed.
Ellen, given the high-flying stocks, given the fact that equity markets are at new highs again and again, does that complicate the urgency to try to get something done, as you say, on the fiscal side? In other words, is the high valuation of equities actually hampering the fundamental recovery of the economy?
Well, hampering the fundamental recovery, no, but hampering what typically are drivers of Congress to act quickly, yes. And, you know, there's nothing like good old market volatility and sell-offs and really bad data coming in to get Congress to act quickly. And we've just not been forced by that. We're trying to be forward-looking here and call for fiscal, you know, further fiscal support before we see broad swaths of the labor market get sent back home. If the virus tightens its grip over the winter and we see further shutdowns. But certainly, you know, if we got that negative payrolls print today, which we're not expecting, but as John pointed out, there's a big spread and there are some expectations for a negative number. Certainly that would impress urgency upon Congress to do something. And I think the bizarre thing out of today's payroll print is if it is a bad print, folks might take that as a good thing because it might push Congress to act.
Ellen, I want you to help your colleague, Mike Wilson. I know he listens. He hangs on your every word. But I want you to play equity strategist right now because it is part of economics. NASDAQ 100 off the financial crisis trend is out 3 standard deviations. It's an exceptionally elegant chart, and it shows the monetary and fiscal oomph of the nation, which has driven equities. There's no question about that. Do you just assume a mean reversion of equities within a 5 or 10 year view? Is that just part of your playbook that you got to tell Mike Wilson about?
Yeah. I don't think I give him advice on where equities will be. And as you know, when economists put on a strategist hat, it can be pretty dangerous. But he's got a target of 3,900 on S&P at the end of next year. And I think people are going to be surprised at how much economic activity we pick back up over the course of the year as we're rolling out the vaccine. I can tell you from just a personal experience, as soon as the efficacy rates of the vaccine began getting reported and that were so positive, you try to pick any summer travel place and have it with a healthy cancellation policy. And the 2 of the top 3 places we wanted to go to were already booked. People were booking that quickly. So I think we will be surprised at how quickly activity comes back. And I think investors are looking forward to that. That's a very simplistic view compared to what an equity
from
strategist
Boeing and Ryanair yesterday. Ellen, thank you, and thank you for phenomenal guidance through much of this year. Ellen Zentner of Morgan Stanley, thank you very much. Ellen Zentner and the team looking for 6:30 at 8:30 Eastern time when we get that payrolls report. Tom Key, the median estimate, 460.
Yeah, big numbers. I mean, they're great. Usually, folks, the average here is 200,000 is a big deal, maybe 175 with the new population dynamics. We're well above that, John. But you know what? It's about December, and we'll try to glean some of the whispers there out to the first week of January.
From New York and London this morning, good morning to you all. Alongside Tom Keene and Lisa Abravitz, I'm Jonathan Ferro, counting you down to Payrolls Friday, and then the reaction from the White House shortly thereafterwards. We'll catch up with Larry Kudlow, National Economic Council Director. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President-elect Joe Biden plans to fight the spread of the coronavirus from day one of his administration. In an interview on CNN, he said he would ask Americans to wear masks for the first 100 days he's in office. Biden has also asked Anthony Fauci to stay on as the government's top infectious diseases expert. And President Trump is again threatening to veto a defense spending bill unless Congress also strips social media platforms of a key legal shield. Both parties have agreed on the bill, which authorizes military pay raises, amongst other things. The measure is expected to pass despite the president's veto threats. The first U.S. state to tell residents to stay home to fight the coronavirus is about to do it again. California Governor Gavin Newsom warns that most of the state could be ordered to shelter at home within days. He says he'll order lockdowns on a regional basis once hospitals run short of intensive care beds. California has the fastest increase in infections since the pandemic began. And Brexit negotiations have hit a last-minute snag. A British official says that trade talks are at a very difficult point. Trade talks that were on the verge of a breakthrough descended into a fight between the UK and France. British officials say the European Union turned up with a new set of demands. They aren't saying what those demands are. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Regions where the ICU capacity is falling below 15%, we are now mandating that we are implementing a stay-at-home order for 3 weeks. When the region is placed in the stay-at-home category, the bars, wineries, personal services, hair salons, and the like would be temporarily closed for that 3-week period.
California Governor Gavin Newsom laying out a reaction function of policymakers in the state of California on a potential stay-at-home order. It comes down to one thing: healthcare capacity, ICU capacity. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro, counting you down to Payrolls Friday. We're about 42 minutes away with equity futures, Tom, up about 11 points. We advance 1/3 of 1% on the S&P 500.
Jobs day at 8:30, and we'll give that to you. And, of course, looking forward through December to January as well. As many of you know, Sam Fazili, our great pharmacologist expert, and myself, we take real issue with the cases mathematics of the pandemic. Drew Armstrong of Bloomberg News is acutely aware, as John Farrell mentions, it's about hospitalizations and those constraints, and it's about death. Focus in the United Kingdom on a per capita basis. As we speak, the deaths are greater than they were at the worst for the United States in April or May, again on a per capita basis. It is a grim December. Drew Armstrong, the vaccines are going to come. They're going to come later. What do we do in the meantime?
Well, I think what you're seeing happen in the meantime right now is a return to some of these lockdown and stay-at-home orders. You know, as you guys were just discussing earlier in the program, you know, California issuing what they expect within days is going to be essentially a return to some of those spring restrictions with limits on activity, capacity limits at businesses, and encouragement of people to stay home if ICU capacity in the states drops below 15%. You know, the main thing I think that's a little bit different about now in the spring and what we're seeing in these stay-at-home orders is that they do seem to be a little bit more regional, a little bit more targeted, and kind of condition-based of, you know, go in and out based on how hospitalizations look. But nonetheless, it does seem like we are heading back to formalizing some of these restrictions that have been going on and off throughout the year.
Drew, there's also the change now of the vaccine, which does seem more imminent. And yet there have been numerous reports, some conflicting ones, about supply chain disruptions and just how quickly that vaccine can get distributed. How do you make sense of what we heard out of the Wall Street Journal yesterday about Pfizer and supply chain delays?
Yeah, I think the thing that's important for people to remember, and that we've heard from public health officials over and over again, is that a vaccine does not do any good if it is just sitting on the shelf of a pharmacy or rolling down some factory line. And it only works when you have shots going into people's arms and building immunity around the community. with regards to some of the reported delays in Pfizer cutting their expected global rollout this year from 100 million doses to 50 million doses because of some manufacturing issues. I frankly think it's actually shocking that we haven't seen more of this. These are new technologies being developed in absolutely record time with global supply chains. Think about how complex these are with, everything from very, very sophisticated molecular components, chemistry that has to be done and keeping these things in solution, manufacturing millions and millions of glass vials, and then the logistics of getting them all over the country and all over the globe, stored at the correct temperature. It's really shocking. Not only that so far most of these vaccines that we have seen in final stages appear to work quite well, but then that you haven't had more manufacturing hiccups. There's a lot new that's been going on here and that is being done. A surprisingly little amount that has gone wrong. I think everybody should be prepared for more hiccups like this, just as a natural kind of expectation that this is tough to get right.
Yeah, especially given pretty ambitious plans from a number of governors in states across the United States trying to say how quickly they're going to roll out this vaccine. How does it complicate the matter that there isn't necessarily the same kind of federally organized response as there is in other nations, say, around the world?
Yeah, I think that that's probably correct. One of the things we've talked about a lot here internally is the fact that you look at the Warp Speed vaccine program, and it's a pretty amazing accomplishment, but it also brings into rather stark relief, the lack of that kind of coordinated federal response where you bring the full might of the might and power and resources of the American government combined with the full might and power of American industry and science to a problem. I think a lot of people have rightfully asked, where was the Warp Speed for getting schools back open? Where was the Warp Speed for testing back in the spring? Where was the Warp Speed for figuring out exactly which public health measures were going to work? A lot of smart people working on those problems, but not necessarily at the fully coordinated, fully resourced way we saw with vaccines in the United States.
So, Drew, let's finish there. The President-elect Joe Biden is talking about a 100-day mask advisory as soon as he takes power, January 20th. It's a month or so to get there. What is being requested right now from the federal government that isn't being delivered?
I think you actually don't hear a whole lot from the leadership of the federal government, frankly. It just doesn't seem to be a major focus. You do hear from health leaders, people at the CDC, kind of one layer down in the health agencies to really, really emphasize the messaging around these public health measures. Staying at home, stopping spread, wearing a mask, doing all the things that they've been asking people to do for months and months and months this year in anticipation that this is going to be a very tough winter until a vaccine does get here. So I think it's kind of going to be more of the same and in all likelihood, lots more cases, lots more hospitalizations, and unfortunately, lots more deaths.
Sadly so. Hey, Drew, thanks for your time this morning. Thank you. Drew Armstrong, Bloomberg News Senior Healthcare Editor. Tom Keene, January 20th feels like an absolute lifetime away.
Yeah.
To be even thinking about policy, a 100-day mask advisory, even if it sounds sensible right now, to get to January 20th, Tom, feels like a long time away.
This could be a 15-page Sunday magazine article, John. You're 100% right. And what's so interesting about it is we're losing sight of some of the more present dates, like the government shutdown, December 11, December 12. I believe that's almost on the edge of tomorrow, John.
Are you surprised by how little January 5th is coming up in conversations with market participants? Because I've got to say, Tom, I am. Hardly comes up, hardly see it in research, not really talked about.
I bundle it all in together. It's distracted. And I will say, John, and it's just from my experience in New York with all the advantages I have, people are shell-shocked right now by the pandemic. You can see it top to bottom. There's been a real shift. And by no means do I say the island of Manhattan is anything as serious as what we heard from Governor Newsom at the top of this segment.
Well, Lisa, just to finish on the point of looking ahead to January 5th and beyond, it's the difference between getting a $500 to $1 trillion plan over the line and adding to it in a big way or not over the next couple of years.
It's massive, and I would argue this is one of the biggest risks or potential factors for the bond market because you've seen those yields really respond to every stimulus headline, almost more than anything else, John.
From New York and London this morning, good morning. It is Payrolls Friday. The Payrolls Report is 34 minutes and about 15 seconds away. Coming up on this program, Julia Coronado, Macro Policy Perspectives founder and president. This is Bloomberg.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The world is desperate for yield. The world is desperate for income.
With vaccines in sight, there is much hope.
We are in the beginning of a new economic and market cycle.
By the end of this month, the market will be very overbought. The breadth will start to narrow.
We still have a lot of bad news to get through over the next quarter or so.
Certainly some support is going to be needed going forward.
This is a time when we should not be worrying about $100 billion here or $100 there.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, Tom Keene. It's Jobs Day. We welcome you on the simulcast, Bloomberg Radio. and Bloomberg Television across this nation and worldwide as well. The stew of news is just extraordinary. An important moment will be Lawrence Kudlow after the jobs report. I believe Mr. Farrow has that lined up. But, John, I want to talk for a moment here about the markets. The Dow, Boeing, affected. Boeing down 28% year to date. John, the Dow up single digit, 5%. Look at it, John, 13% on the Standard & Poor's 500 year to date. And the NASDAQ 100, and Lisa's loaded the boat on the NASDAQ, up 38%. John, this is a boom and great bull market.
Record on the NASDAQ, just off that on the S&P 500. And this market, Tom, has ignored all the bad stuff over the last month and held on to all the good stuff. Does that change in 29 minutes? The payrolls report, the estimate, 460. Ellen Zettner and Morgan Stanley saying maybe a bad print is good news because it gets the job done, sealed, delivered down in D.C., Tom.
Well, we'll see in the stimulus, of course, front and center. Kevin Cirilli talking about the enthusiasm there to get something done. We'll talk about that in a moment. Lisa, I love what Greg Peters of PGIM said there in the opening credits. The idea, Lisa, that everybody's looking for every bit of yield. And to me, that's been an undersold story this week about how other credit has really moved with a vengeance, price up and, yield down.
One of the most shocking speakers in this entire day, I think, is Priya Misra when she came out and she said the Fed is probably going to extend the duration of their bond purchases at their meeting later this month, not because they think that monetary conditions need to be easier, but because markets would throw a tantrum. We would face another taper tantrum without their support. They are backstopping these valuations going forward, no matter what happens with the jobs print or anything else, Tom.
Surveillance confession right now. Lisa Bramowitz and Tom Keene, we could care less about next year's outlooks. John Farrow reads every damn word of every single 2021 outlook. John, what's the blend of those outlooks so far?
You really want me to do this right here, right now?
Throwing me under the bus for this, are you?
Small caps over big caps, value over growth, cyclicals over defensives, international over the United States,
Tottenham over Arsenal,
underweight core government bonds
watch it there,
in the
Tom.
United States and Europe. I mean, we've heard it all before, haven't we? You'll hear it again, I'm sure, at some point today, right here on Bloomberg TV and radio.
Here's what's important in Bloomberg journalism today. A good friend of John Farrow's, Andy Felstead, over in London, writing it up on the real backstory of 2020. You can't get a dog, you can't get a cat. Farrow riveted on cat news. The average price of a cat was 42% higher this year. What's the benefit? Or as Andrea would like to say, what's the return on invested cat? I love that. CFA level 3. A cat generally costs between, and this is in pounds, John, you'll have to translate, a lot of money and a lot more money over its lifetime, excluding vet bills. Some people like Farrow may be forced to part with their cats. John, I thought that was very important.
So you've gone from Dow points to 2021 outlooks to the animal that I absolutely...
We're just...
I'm not going to say it. The last time I said what I thought about cats, people called in and complained.
They did.
So you're not taking me there. I'm not going to say it. Carry on.
And we'll carry on. Julia Coronado joins us right now here as we look at the news and the serious news of the moment in this pandemic as well. With macro policy perspectives, Julia Coronado was dead on economic growth coming out of the financial crisis. Julia, what's your call for the next 12 months on economic growth?
Well, there's a real dichotomy between the near term, the next 6 months, and then the 6 months that follow. So we have a pretty flat profile for the next 6 months. We get a little bit of stimulus. We're not expecting a big package, although, there's hopeful noises, but we've heard hopeful noises before. And more importantly, the pandemic itself keeps people on the sidelines, keeps activity on the sidelines. We really can't return to normal until we see people have confidence in their health. And so we expect that later in the year, second half of 2021, where we expect we can get a nice surge in pent-up demand for services, which is what is still lagging both in hiring and in spending. It's the services sector, which is 85% of the U.S. economy, is still lagging behind.
Julia, getting a read on the economy right now, I'm actually finding quite difficult. Claims has been really dicey in the previous couple of weeks, a little bit better this week, though. we've been told it comes with a health warning. You can't trust these numbers. I'm looking at the ISM. The employment component was quite soft on the manufacturing side earlier this week. How do you, as an economist, look at the data coming through, the high-frequency data, and put together some kind of estimate as to what November looked like?
Yeah, boy, the tea leaves have never been harder to read. We know all of the data is measured with a lot of error right now, partly because data collection has been disrupted by the pandemic itself. And this month is really hard because we've got some of the high-frequency hiring indicators that come from the small business sector have rolled over and are suggesting a negative print this morning. But the broader indicators like the ISM services, consumer assessments in the Conference Board survey, claims are holding up okay. So we kind of split the difference and are looking for a 250K gain this morning, which is in normal times very solid. Of course, it's not good enough when you're 10 million jobs in the hole. So it would be a little bit of a worrisome moderation and just kind of confirming that the pandemic is taking a toll. And that might be inevitable in the near term and really highlights, I do agree with what you were saying earlier, that it could be key, though, in getting the stimulus over the finish line, which has been just like watching Lucy in the football.
Oh, yeah.
Watching these negotiations.
It's been fun. It's been real. Julia, I will say there is a question of what the value is in this jobs data if it is so messy. Even if you get the headline right, you know, is that the value or is the value elsewhere? What are you going to be looking for in today's report beyond just the headline?
So, of course, we're concerned about labor force participation. We've one of the reasons the unemployment rate has dropped so quickly is that we've lost a lot of people that have given up looking for work who have to stay home with their children, so more disproportionately women. So we're definitely looking at participation. Of course, I don't expect a rebound right now because of the pandemic and the school disruptions that are ongoing. But that's something that we keep an eye on. Also, just the composition of job gains and whether we are seeing that resiliency in the goods producing sector. As Jonathan mentioned, the ISM manufacturing hiring component rolled over. That's been doing a lot of the heavy lifting and the resiliency we've seen as the goods producing sector. So we want to see that continue.
And Julia, what's so important here, and John nailed it because he's reading all those 2021 outlooks that I'm not reading. But Julia, what's so important here is the goods sector resiliency, as you and John mentioned, and also the distinction of the service sector. Are we going to see a reversion to 3% inflation in service sector, or are we going to sustain this disinflation? Which is it?
Well, I think we have to be careful when we talk about inflation and distinguish it between one-off changes in prices, level shifts in prices, and actual ongoing price increases. I see a lot of confusion in how we talk about inflation. So we don't think we're in deflation just because airfares are low, right? It's just a one-off level shift down with weak demand, and then it will rebound. Inflation, ongoing inflation, which is broad-based increases in prices, has to come from the labor market. It does have to come from increases in purchasing power. Otherwise, jumps in prices. It's why we ignore commodity prices when we're looking for the tea leaves of trend inflation. It's just a demand destroyer or a purchasing power enhancer, depending on which way the prices are going. It's not inflation or deflation. So there's a lot of excitement about the potential for inflation in the second half of next year. If all of that is reversion to normalcy in services prices, that's not inflation. That's a level shift in prices. What's going to happen in 2022 depends on how strong the labor market is, how much bargaining power workers have in their wages, et cetera, et cetera. So I do think we could see some reversion if we get a surge in demand and a recovery in services in the second half of next year. That doesn't lead me to boost my forecast for inflation 2022 and beyond. That will depend on the broader strength of the economy here and abroad.
2020, not over. Already talking about 2022. Julia, we always appreciate your time. Thank you for joining us. Julia Coronado, Macro Policy Perspectives, always smart. Always sharp. Thank you. The payrolls report in about 20 minutes' time. The report. I'll get my words out properly. Tom Keene, the Fed is just going to sit this out, no matter how good things get through 2021, no matter how much things improve. They've already told us they are going to sit this out?
Yeah, I'm glad you bring that up because I'm behind on this, John. You know, I used your vacation days and was away here. You can do this, folks, on the Bloomberg Professional Service. I can look to the January 27th Fed meeting. John, can they even wait that long? I mean, they're going to get a jobs report first week of January. The other sport, 7 days before the inauguration, do they act before January 27th, even with or without stimulus?
So I don't think there's pressure on the Fed to act right now at all. Financial conditions are still really, really loose. I think what they will have at the end of January, Tom, is some clarity on what the Senate looks like. And then they can start to get their hands around what fiscal policy is going to look like for the next 2 years. And I actually think that's really important. Mike Schumacher of Wells Fargo made that point. Why would you believe that the Fed in 2 weeks' time is going to do something big, drastic, significant, material with the asset purchase program when they don't know what Congress will look like for the next couple of years?
But what's so important is the conversation, John, of 2 weeks ago is different than now just because of the stimulus talk of the last 48 hours. I mean, there's been an abrupt shift, and we have to see where that goes in these remaining days.
Agree, and where I think there could be an air pocket is in treasuries, and Priya Misra of TD Securities touched on this. If enough people expect the Fed to do something in a couple of weeks' time on extending the average maturity of the asset purchase program, that could get a little bit messy. It depends how much they're willing to look through that. Alongside Tom Keene.
John, David in Brooklyn says he's got cats for sale.
Straight to the break.
Keep trying, John.
I know you've got something else to say. I'm going to talk about your Christmas tree habit in a minute. Do you know what Tom Keene does for the month of December? He buys a tree, he doesn't decorate it, he leaves it there for 3 weeks. And then, literally, before he goes away for the week of Christmas, he decorates the tree, and it sits in the living room with nothing on it. I've seen it, and I have photos. That's my comeback. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The Justice Department is in talks about resolving charges against the CFO of Huawei Technologies. It's a long-running dispute that's fueled a clash between the US and China. Canada arrested Meng Wanzhou 2 years ago on a US request, and she has been confined to the city of Vancouver ever since. Dow Jones reports there is talk of a deferred prosecution agreement on violating sanctions against Iran that would allow Meng to return to China. On Capitol Hill, the chances are now higher for a deal on a stimulus package by the end of the year. A bipartisan plan endorsed by Democratic leaders as a basis for negotiation is now getting more interest from the Republicans. The proposal calls for spending $908 billion. That's less than what Democrats are calling for, but they say it is a starting point. And DoorDash has boosted the price range for its IPO and is now seeking to raise $3.1 billion. The biggest U.S. food delivery company is marketing 33 million shares at $90 to $95 a piece. DoorDash is part of a group of consumer-orientated web-based companies that have IPOs lined up for this month. Airbnb is another. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus and we need it relatively quickly because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures because you have no other way at the beginning. This is your best weapon and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Welcome to That's Debatable, an interactive series on today's most pressing issues. This week's resolution, should we stop worrying about national deficits? We'll hear from both sides.
Every deficit is good for someone.
There will be automatic spending cuts if nothing is done.
And we'll get your perspective too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
Particularly, sort of technology landscape, gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is the moment to use fiscal resources. So I would go bigger now rather than smaller. And when the crisis is over, talk in a reasonable way about how to get back to a sustainable path. And I just want to be clear, the crisis being over is when most of those 10 million people are getting back to work and the unemployment rate is starting to look the way it did before COVID.
And we hope we get there quickly. That was the former U.S. Treasury Secretary Jacob Lew earlier this week on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz this morning. Good morning. I'm Jonathan Ferro, live from New York and London on Bloomberg TV and radio. Your payrolls report 12 minutes away. Price action looks like this going into it. The median estimate 460,000. Equity futures up 11. We advance 1/3 of 1%, looking for another all-time high on a benchmark in America. In the FX market, euro dollar just off highs for 2020. Euro dollar 121.57. And the story of the week, arguably, cross-asset worldwide. The breakout again in 10-year Treasury yields up another basis point or two on the day, Tom. Your yield on a 10-year maturity 0.9228%.
John, commercial banking is simply the relationship of banker and client. At J.P. Morgan Chase, James Glassman has spent a distinguished career speaking to J.P. Morgan clients, business, small, medium, and large, about the state of the economy. And best of all, Dr. Glassman has listened to them. Maybe more than ever, it's now good to speak to Jim Glassman about what he's hearing across this nation. Jim Glassman, what are you hearing from J.P. Morgan clients?
And the truth is you learn more when you listen to people than they learn from you. Yeah, what I'm hearing, it's very mixed, right? This is a Charles Dickens year. Some people are just unbelievably doing really quite well. Others are struggling, and the guys that are struggling, the restaurants, the bars, the air travel system. The guys that are not struggling are the ones in real estate, consumer products, capital spending projects. So I think everybody is a little baffled because from their particular perspective, they see a lot of noise. And depending on where you look, it could be either great or awful. But so I think people look to folks like you and me for guidance because we're supposed to be looking at the broad picture. And I think I try to translate what I think is going on in the equity market for them. And I think most people buy the idea that the fundamental issue here has been if you get a medical answer, you're going to be thinking very differently about things in a few months, maybe by next summer, as Tony Fauci says. We won't be talking about pandemic by then. So the medical answer has been the key issue here. We've already seen some pretty tremendous progress in the job market with all the help we got from the initial rounds of fiscal stimulus. People are seeing that, and they feel it. They are becoming, the folks I listen to, they seem much more confident that we're going to get out of here. And I personally think, they may think I'm too optimistic. I tell them by this time next year, we'll be back where we started the year. They may think that's optimistic, but they kind of know where the drift is going. And it's all about the medical answer, which we now know has a very good chance of working and getting out there.
So, Jim, this is the common line, the idea that equity markets are pricing in the future. Is that what's really going on with the equity rally, or is there some sense that investors are looking at the now and seeing profits that are pretty darn good for the big companies,
that's a good point.
And they're buying because they got cash?
Well, that's a good point, because until last week, I kept telling myself, it must be imagination that's driving this. We think this is making us more efficient. We saw all this fiscal stimulus. We know there's a medical answer in the pipeline. But honestly, when I saw the news last week on the profitability of companies in the third quarter, after-tax profits of non-financial companies rebounded to an all-time record high. And that's put us right back into this zone that we've been in the last 10 years. So you might be right. It might be that equity investors they hear all this stuff about, it sounds too abstract to them. They're trained to look at performance of companies, and a lot of these companies are doing really well. And I think the shock of COVID, which is forcing us all to go online and business, working from home instead of the office, is making businesses much more efficient. And maybe that's what's showing up, and maybe that's what's driving the equity market. Because if I didn't know, if I didn't have a view about the future, and I'm just looking at the reality I see now, as you point out, is pretty much impressive.
Jim, if I didn't know, I'd think the Fed was buying equities, and I think that's the story for many people looking at financial markets.
I got to tell
it's
you,
the policy response to this.
Yeah, this is the biggest, to me, the most unusual thing in my career is to see the value of the U.S. stock market running up to almost twice the size of the U.S. economy. I've never seen that before. And I think it tells you the equity market is looking beyond this crisis, and it's telling you something big is going on in the world. And it shows up in the change in attitude about inflation from the Fed. It's the innovation that is giving us ways to transition through this crisis pretty easily. And the globalization is not changing.
It's been a powerful transformational force. In about 7 minutes, we'll have some payrolls numbers. I want to talk about the labour market with you, Jim, if we can. In the ISM earlier this week for manufacturing, the employment component was a little bit soft. And within the report, there was a quote from the ISM talking about absenteeism, the struggle with hiring, getting workers to return. Are you hearing the same kind of things, Jim?
I was hearing the same kind of things back in June. People were saying, I'm having a hard time getting my people back off of unemployment because people were getting compensated pretty well on unemployment. Well, some of that is expired, right? So it shouldn't be all that difficult. So I think the best thing you know about the job market, frankly, is the weekly insured unemployment trends. They're no longer distorted like the GAO claims. That's a bigger problem for the PUA program. But it's only a distortion if I'm having to file multiple back weeks of claims. This is not so anymore, and the trend in insured unemployment, counting the guys who are running out of benefits, has been improving very steadily. A little less dynamic in the last month than it was before, but it's still showing you a gradual trend in improvement, which is surprising because you would have thought that all these new lockdowns would be taking some of the steam out of the momentum in the job market. I think it's a reminder that we still have a lot of momentum out there from the earlier actions this year, and now we're just waiting for that vaccine distribution.
Decent momentum, still a lot of work to do. Jim, we've got to leave it there. Jim Glassman at JP Morgan Chase Commercial Banking. Thank you, sir. Let's pick up the pace a bit. 6 minutes away from the payrolls report. Your estimate, median estimate in our survey, 460,000. That's the headline number we'll be looking for, Tom, in about 5-6 minutes' time.
Yeah, frame the data. Let's say the data's not going to move, and the data's going to move in 4 weeks, the first week of January. John, what we need to focus on is a 10-year yield at a 0.92% is distant from a 0.70% of not too long ago.
How high do you want to drive these yields going into a Fed meeting just a couple of weeks away, Lisa? I think that's got to be the question many people are asking themselves right now.
Yeah, and a lot of people are not going to potentially sell treasuries because they believe the Fed will come in and be that put if yields go too high. The key to me is what's the breaking point for the Fed to get in and take action? Are they going to do it preemptively to avoid a taper tantrum, as Priya Misra was talking about?
Is bad news good news? It's good news, bad news.
Oh, he's exhausted
I can't get my head around it. I always find this absolutely amazing. If you accidentally tune into a business network for Payrolls Friday and you hear people talking about this, we'll try and explain it in about 5 minutes' time. The payrolls report is just around the corner for the United States of America for the month of November. Your estimate, 460,000. Your previous number, 638. Full coverage and breakdown with Michael McKee and BlackRock's Jeff Rosenberg. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. For our audience worldwide on Bloomberg TV and radio, payrolls next. This is Bloomberg.
Retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
For our audience worldwide, live on Bloomberg TV and radio, the payrolls report just seconds away. The median estimate, 460K. The previous read, 638. With the number, here's Mike McKee.
All right, John, we're just getting the numbers in now. 245,000, a significant decline from what we saw last month of 638,000 unrevised.
The forecast, as you mentioned, was for 460,000. The unemployment rate does drop as forecast to 6.7% from 6.9%. So there's a good data point in that. We do need to see what the overall labor force participation rate is, and I'll get to that as we go along here. And let me just quickly see what we got. The participation rate is up. The participation rate falls to 61.5 from 61.7, so that may explain some of the reason we're seeing a lower unemployment rate. Average hourly earnings up 0.3. That leaves us at 4.4% for the year, but of course that is dependent on the fact that there are fewer people who make less money in the payroll numbers at this point. Taking a look at some of the details here, the unemployment rate down by 8 percentage points from its high in April, but it's still 3.2% higher than it was in February. The number of persons on temporary layoff, and this is something everybody's been watching, has decreased by 441,000 in the last week to 2.8 million, down from 18.1 million in April, but 2 million higher than February. The number of permanent job losers at 3.7 million is little changed from the month before, still higher than it was in February. And the number of long-term unemployed is up by 385,000. These are people who have exhausted their regular unemployment benefits. The number of people who are, let's see, higher teleworking. This is always an interesting number. Teleworking. Up from 21.2% to 21.8%. So more people staying home to work from home. The number of payroll numbers for September revised up by 39,000, so better news, 711,000 in September. October, though, revised down by 28,000, so we have a net 11,000 additional employees over the 3-month period.
Mike, I want to give you a chance to breathe here, and also, folks, I really want to emphasize here, the way it's distributed now is different. I don't like it. Mike McKee doesn't like it. Nobody likes it. It was better when McKee was hermetically sealed in the lockup before. What I'm seeing, Michael McKee, off of this, off the Bloomberg, is a set of headlines showing the two Americas. The number of U.S. unemployed for 27 weeks rising, almost 4 million. A stunning headline, if I can find it right now. Michael McKee, the jobless rate would be 0.4 of a percentage point higher if workers were classified correctly. Michael McKee, do you trust this data?
You trust the data as much as you can. The BLS is doing the best it can to adjust.
Fair.
And they do come up with this alternative unemployment rate number. And it's basically the data that we have. And we know that statistically it's about as good as you're going to get given how much data they collect and the difficulties in this pandemic. So, it's comparable to prior months, so that at least gives us something to work with. Quickly looking at some of the numbers here in terms of hiring, government employers down, employment in local government down 21,000. We saw 86,000 fewer people working at the federal level, but that's because the census is ending. So some distortions upward now coming down.
John, what do you see in the markets?
I think we've got to go straight there. Intraday, S&P 500, can barely see it. Quick drop off the back of a huge downside surprise, then a quick pop off the back. Now we're higher than where we were before the number. That's the story in equities right now, shrugging this off. And we talked about this 1 hour, 30 minutes ago. This number for this market is going to be seen as stale. It's important for policymakers, and maybe this is the thing that drives them over the line down in Washington. Check out 10-year Treasury yields. They don't move lower. They pop a little bit higher. On a session now, on a 10-year, up by 2 or 3 basis points to 0.93%. Euro dollar just breaking out just a little bit. These are subtle, mild moves, and I don't want to draw too big a conclusion on this, Tom, but I think for many people coming into this print, it was less about the meaning for markets directly and more about what it meant for the policymaker down in Washington.
Well, I love your idea of subtle moves. Michael McKee, just very quickly here before we get to Jeff Rosenberg, I mean, this is really, really important. Did we get a little bit of an advance here on the December report due the first week of January? That disappointing non-farm payrolls, did that have a December-ish feel to it?
Well, it does. Remember, the survey's taken in the week, the pay period that includes the 12th of the month. So this is really the first half of November, and we've seen a lot of lockdown activity since then, and it just continues to get stronger. So you can expect a disappointing number in December. One of the weird things about this number, This is the holiday hiring season, yet retail hiring went down by 35,000.
Interesting. Some of the detail there, we'll glean that through the morning. Of course, Michael McKee will parse all of that data. John, with these market moves, it's important to bring in our next guest.
Jeff Rosenberg joining us now from BlackRock. Jeff, let's get your ready take, please. Your thoughts.
Yeah, John, I think you really hit the nail on the head here with this market reaction. You know, it's a weaker report than expected. You know, certainly you're seeing the impact of the pandemic surge here, particularly strong in leisure and hospitality, which disappointed to the downside. And the market reaction is really looking through this, as you highlighted so importantly, to the policy response. Obviously, this week we've had a lot of acceleration in terms of movement on that. And this is the kind of news that the market is interpreting as pushing them over the finish line. And that's why you see bond yields a little bit higher. You see a little bit of steepening in the curve. You're absolutely right. These are very small moves, but it's not the kind of response that you'd expect from a disappointing payroll report, yields rally, curve flattening, because you're seeing the anticipation that this is reminding us that this is about the pandemic and it's about fiscal policy. And this implies a better expectation for fiscal policy that eases the pressure on the monetary policy to have to do more to restrain yields. And that's why we're seeing a little bit of curve steepening, higher yields, barely, but higher in response.
Jeff, do you think that markets are right here? Do you think that this is bad enough news to prod policymakers into the potentially good news for the economy of passing some sort of fiscal support bill?
Well, it's not so much that this is bad news. I mean, it's disappointing relative to expectations. But again, remember how wide the expectations are. Moreover, what it's really a reminder of is just that we are seeing a slowdown. We're seeing a weakening. You're seeing particular sectors get negatively impacted. It's a reminder of how important the fiscal policy response needs to be, given the surge that we're seeing across the nation in the pandemic.
Jeff, let's get out front of your monthly note here. We saw ECB talk about extending bond buying today. What is the Fed's flexibility to deal with this labor economy, the new politics of the nation, and their ability to buy assets? Does any of that change into the new year?
Well, you know, obviously we saw some of the change with regards to ending some of the CARES Act's flexibility. The most important policy supports were extended into the new year. So certainly some of the most extreme market reaction, policy reaction, I should say, responses are starting to fade. That doesn't mean that we can't re-up them in a new bill, that we're either contemplating this year or next year. I think the Fed retains tremendous amounts of flexibility to respond, but their response, as they have been saying themselves for so long, is limited in what monetary policy can do directly. What monetary policy can do, most importantly, is to support fiscal policy. But it's really the fiscal policy support through the employment support, through the extension programs, that is the direct support. What the Fed is going to do is they're going to mitigate any market reaction to future expansion of debt, impact on debt service. They're going to maintain the ability of governments. And this is not just the Fed. The ECB, as you highlighted in your question, is also pursuing exactly the same kinds of policies. Enable fiscal policy to provide as much support as needed without the cost of increases in interest and debt service.
And Jeff, that could mean extending the average maturity of the purchase program over at the Fed. That meeting 2 weeks away. Your yield on a 10-year right now, about 93 basis points. Jeff, how far would you push that move on a 10-year yield before you think the Fed gets a little bit uncomfortable?
Well, you know, I don't think the Fed gets as uncomfortable with small basis point moves, 5, 10 basis point moves as we do. I think 93 basis points, 100 basis points, 125 basis points, that may be a little bit more. It's really about the pace of increase that the Fed will concern itself with. So if you're talking about in the next 6 months, a gradual increase in interest rates, I don't think the Fed needs to react to that. What the Fed would be reacting to would be a very sharp rise in interest rates. Certainly, we saw that during the taper tantrum, the Fed's history. They react to big moves because that's disruptive to financial market conditions, to financial market functioning. Small moves and slow moves that the market can absorb, I think the Fed can absorb. But they're going to want to keep the lid on interest rates here, particularly because of the benefits that we're seeing to the housing sector, right? The most interest rate sensitive sector is benefiting greatly, and those benefits extend spend across the economy, they're going to want to ensure they retain those benefits as we go forward.
Do you agree with Priya Misra that if the Fed does not extend the duration of their bond purchases at their meeting in 2 weeks, that there will be a taper tantrum?
I'm not sure there'll be a taper tantrum of the sort that we saw during the original taper tantrum. Certainly, there's a lot of expectations built into will they, won't they extend. But I don't think the extension in the December meeting will result in such a large disappointment that you see a taper tantrum outcome. I think you could certainly see some rise in interest rates, some steepening of the curve, but it's a lot more uncertain whether or not at this point in the economic pandemic cycle, they need to spend that bullet. And because of that, I think the market is more balanced with regards to the potential reaction. Certainly the reaction might be a little bit bear steepener, but not so much to call it like a taper tantrum.
Jeff Rosenberg, thank you so much with BlackRock. Let me do a data check before we go back to Michael McKee, who's been studying the state of this American labor economy. Futures up 13, the VIX 21.00. As John Farrell mentioned, down we go abruptly and come right back up in yield, 0.93% on yield. 30-year bond, 1.68%, maybe a fractional dollar weakness here as well. Michael McKee, in honor of Bernard Bailyn, the great historian who died this year, I want to talk not about the depeopling of America, but the de-employing of America. It is stunning, Michael McKee, as you know, where the employment ratio of this nation is versus the peak of 2000 or even the average of the last 30 years. How unemployed is America?
Well, we're still significantly unemployed, and I can actually give you a figure on that. I believe the Labor Department put something out in terms of the total number of people who are unemployed here. See if I can find it while I tell you here. I mean, we're still 10.7 million people below where we were in February when we started this. So there's still a lot of people unemployed just because of this. Now, we're also seeing trends in labor force participation decline because the baby boomers are retiring, and we're also seeing the impact. Yeah, everybody's wondering why you're still around.
Yeah,
particularly Farrell.
Lisa's been asking.
Keep it up, McKee.
Really?
Why doesn't he go away?
You're going to throw me under the bus again. My God.
The other issue we have, of course, is schools being closed. And so a lot of people, particularly women, having to stay home right now to take care of children. So there are a lot of people who are not in the labor force and a lot of people who are unemployed right now, and there is a long way to go.
Given the fact that there is this unemployment, this permanent unemployment that is bleeding into the figures, what is the real unemployment rate? We're looking right now at a headline number of 6.7%.
Well, 12% is the U6 number. There are other people who calculate it a little bit differently, a little bit higher, but it's still a significant number of people who are either looking for work or discouraged workers or those who can only find part-time jobs. So you look at 12 to 15%, I think, are the rough estimates of where we are with that kind of unemployment.
Mike, I want to turn to the bond market quickly and just get to what 10-year Treasury yields are doing off the back of this number that came out 13 minutes ago. Yields are up by 3 basis points to almost 0.94% on a 10-year now. We've talked about this initial read. It's a really mild move off the back of that downside surprise, but it's pretty clear the conclusion for a lot of people in the early part of the read, Tom, is that this pushes the fiscal talks over the line. That's why you've got a little bit of a lift in yield. You've got equities breaking out a little bit more, up 11, 12 points on the S&P 500. I have no idea if that's where we'll be at the end of the day. That seems to be the conclusion many people are drawing, Tom, just after the data drops.
Yeah, it's a correlated move, and I totally agree with what you're saying. But, John, what I would say that's so important here is the idea of two Americas. I mean, John Edwards of Louisiana, John, this is in your ute, but John Edwards of Louisiana came up with this phrase, and all I can tell you is I've never seen two Americas like I see it this December morning.
Tom, I couldn't agree with you, and this speaks to why me, so many other people, you, Lisa, have been uncomfortable with what is happening with markets and what is happening with society. And the huge challenge of 2020 has been to divorce how you feel about what is happening around you, the disparity that so many people experience and we're aware of, from your outlook for markets, which are trading on the aggregate number. And the question that I would be asking, Tom, is when does the disparity start to matter to financial markets? Because markets will trade on the aggregate number. And I would argue that the disparity starts to matter to markets when it starts to matter at the policy level. And it will matter at the policy level if you get a Democratic sweep. And that's why I think January 5th needs to be part of the conversation in a much, much bigger way, because it could be the difference between two very, very different regimes for the next couple of years on a policy front.
Very good. John, tell us about Lawrence Kudlow. How hard are you going to grill him today?
Look, I think it's probably going to be one of the last times we catch up. The outgoing National Economic Council director. I want to try and gauge, Tom, what this package will look like down in D.C., whether it has the president's sign-off, if it does include $160 billion of state and local aid. That's been the red line over the last several months, going all the way back to July. Has it changed?
That's going to be interesting on those red lines, and John's right. It's a key conversation. Michael McKee, I got 10 seconds with you before we get to our policy expert in Washington. Michael McKee, what data are you going to look for as you stagger through December to that January 1st report?
Well, we'll be looking for retail sales and spending to see if Americans are still going out to spend. As a services-based economy, do we still spend money given this situation, or are people concerned because of these numbers they're seeing and starting to save more?
Michael McKee, thank you so much on the jobs report. And again, futures up 12. Right now on policy, as John Farrell mentions, a key topic with Mr. Kudlow, Henrietta Trays joins us. Henrietta, is the ink drying on a stimulus bill right now? Are you that certain it can get done?
I feel pretty great about it, honestly. I know that's crazy talk after the last 6 months of inaction, but I don't think there's a question of whether or not we're going to get a bill anymore. I think it's what is the size and scope going to be. So I am optimistic. I would say low end 65, 70% odds that we get a bill done in the next 2 weeks here.
Okay, I'm looking right now. The 10-year yield believes your message. Right now, yields breaking out, as John was pointing out earlier, almost now up to 95 basis points as people price in the greater likelihood of some sort of fiscal support package passed in Washington on the heels of this labor market report. Do you believe that, Henrietta, that this was a bad enough report to push any of the laggards on Capitol Hill into passing something?
I really do. I had an interesting conversation with a client yesterday who was still sort of looking at stimulus as unnecessary and saying, you know, the market clearly doesn't need stimulus. And I think that's an outdated way of thinking about how D.C. considers economic policy. This is an anomaly under the Trump administration that anyone cared about the stock market in Washington, D.C. It's about the fundamental data. It's about the jobs data. It's about the unemployment number. It's about GDP data. It's slow moving, but it's exactly this kind of print that makes members in D.C. say, oh, right, stimulus, there's a substantial amount of unemployed. We are having a massive increase in COVID. We're going into the holidays. We're not going to be here for another month and a half. Something now. Let's package. I expect it'll be somewhere in the $600 billion range. That includes $300 billion roughly in money that has already been allocated in previous iterations of stimulus, whether the CARES Act or the PPP program or the ESF programs at the Fed and Treasury level. But there's going to be somewhere in the range of about $300 billion in new funding that goes out just to extend the pandemic unemployment assistance.
Where does McConnell stand? Just, Henrietta, I'm wondering, the key sticking point, as we've been talking about all morning and frankly for a couple of months now, is the funding to state and local governments. What's sort of the tipping point for McConnell to get on board with this $908 billion bipartisan agreement, or something that still includes some aid to state and local governments?
State and local is absolutely a sticking point because you still have this divide mentality amongst Midwestern senators in the red-blue state divide. But I think if you can drill down and stop discussing just state and local broadly, but get into schools need this aid, specifically buses, rail, transit, subways. These programs are going to lay off 10,000 workers. They're slashing their provisions by 40% in D.C., in New York, in Chicago. They are making a lot of noise at the transit level. So I think if you could start talking about transit funding and specific segments.
Oh, come on, Henrietta, I take issue with this after talking to Patrick Foy. Washington hates transportation because they're Democrats in big cities. Is that going to change in the next 48 hours?
I think there's enough of a push, honestly, to get you a small basket of funding for those sectors. It will include airlines, by the way. There's a long way to go there, but I do think that fundamental underperformance and lack of there is something that has shifted in the last couple of months. Yes.
Henry, it's a bit of disruption on your line, but we'll stick with it because this conversation's important. How important are the things that we're discussing right now to the January 5th runoffs in Georgia?
I think that's a really critical question, obviously. It's important because you need enough funding to keep Democrats at home and not enough to alienate your Republican base. So that package that I just walked through, roughly $600 billion or so in spending, does just that. It's no bailout. There's no $300 to $600 a week unemployment insurance booster at the federal level, no direct payment to individuals, none of that, Democratic socialist-minded stuff that will get the Republican senators in trouble, Senators Perdue and Loeffler, but it is also enough to provide aid to the Democrats or the members of the Georgia community who need it the most, mostly in that unemployment insurance aid, to get them to potentially stay home. This is going to be the largest turnout runoff in the state of Georgia per the electoral officials' expectations. The margins are exceedingly tight. The latest data shows that Ossoff is up 50 to Purdue's 48, whereas Warnock is up 52 to Loeffler's 45 in the polls. And Georgia polls, for what it's worth, were pretty accurate in November. So there needs to be a concerted effort to turn out the Republican base, which means the stimulus needs to be relatively small, but there needs to be enough to keep the Democrats home as well, which creates some concern around whether President Trump should or should not go to Georgia, or whether or not they should or should not pass even a minimal stimulus bill this cycle. So I think they will. I think that's threading the needle from McConnell's perspective, and that's what they'll get.
This is not part of the conversation on Wall Street, Henrietta. It barely comes up. The outlooks for 2021 hardly even include January 5th. There is just an assumption that we have a divided government down in Washington, D.C. Do you think that's a mistake?
Well, if we do see the Democrats pick up the next two seats in Georgia, there will be the definition of divided in D.C. 50 is not a functional majority. We're going to need to watch the two at-risk members for flipping sides. That would be maybe Lisa Murkowski or Joe Manchin, a Democrat out of West Virginia. You're going to look at a 60-vote threshold for any legislation, regardless of what happens in Georgia, in my opinion. That is what President-elect Biden is signaling he will make his State of the Union address about, his inaugural speech about, and concentrate on exclusively the coronavirus, the need for stimulus, and that will occupy all of the first quarter, at least, of 2021 until they get it. And then if there is a 50-seat Democratic, quote-unquote majority, they'll try to pursue things like reconciliation instructions and get more funding, but you're not going to see any more legislation pass. So I encourage our clients to focus on things that can change at the regulatory level, and then, of course, trade policy, U.S.-China relations, U.S.-EU relations, U.S.-Japan. That's the focus for the future.
It's a conversation for another time. Henrietta, we always enjoy catching up with you. Thank you. Henrietta Trays there, Verde Partners, the Director of Economic Policy. Here's the story of the last 22 minutes. Downside surprise on payrolls, 245K, the estimate 460. The previous read revised lower to 610 from 638. The market read pretty clear on this. A soft read on the headline number, Tom, being seen as the stimulant to provide the stimulus down in Washington, D.C. Equities higher. Bond yields up and away, up 4 basis points to almost 95 basis points on a 10-year top.
I've never said this, John, but we're on the 1% watch here. You get a set of good news. You're only 5 basis points away. You may get a 1 print today.
You think so?
If you get Mr. Kudlow to say the right things, yes, I think you'll get a. John, the burden is on your shoulders. We have team surveillance. I believe I speak for Queen Abramowitz that the burden is on your shoulders.
Always.
You must get Kudlow to say yield to 1%.
Well, I think to get him to say something that would lead to yields to 1% would mean, Lisa, that there is an agreement down on Capitol Hill, an imminent agreement on Capitol Hill with the state aid, all the above, and a deal that looks something close to $1 trillion, which is the bipartisan proposal, and something a little bit further away from the $500 billion on offer from Leader McConnell.
I got to say, John, this just confirms the charade of the whole thing. It's not a surprise that the labor market is weakening as we have an increase in the pandemic and the virus counts and record numbers of hospitalizations. This is not surprising. It is going to get worse. People are staying home. They have to. People are not going to restaurants. Restaurants are closing. So the fact that this pushes over the edge some talks about stimulus efforts really is notable as far as the PR aspect of it and the idea of trying to garner popular support, especially at the time of that Georgia election, as you keep pointing out, John.
Talks that I might add that have been going on since, Tom, before July on this particular package. We've been talking about this for a long, long time.
I mean, John, you slide in at 6:50 a.m. I'm starting the morning early, and the most important thing I heard across the hours of Bloomberg surveillance was from Ms. Trez. Georgia's a mess. That's the reason they're going to get the stimulus through.
For the Conservatives, for the fiscal hawks, Tom, isn't the equation just a little bit different? I thought she was a bit more nuanced than that.
Yeah, maybe. I don't know. I think that McConnell's going to collapse here on stimulus because he's scared stiff of the outcome in Georgia.
Look, I don't think it's going to be about the data. It's going to be about the economic restrictions that are set to come across states, across the United States of America. I think California has said this is the threshold, and many people, Lisa, think, unfortunately, will breach it.
Yeah, and people are expecting a new rounds of restrictions around the nation.
Well, this was fun. I enjoyed sticking with you guys.
Thanks. Do it again.
You know, your entourage is in lockdown,
the anniversary.
So you couldn't get to the other set. I get it.
We're going to keep talking, John.
They're happy with me. Coming up, Larry Kudlow of the National Economic Council. Reaction from the White House in the next hour on Bloomberg.
Que esses governantes dirigem esse país pensando só naqueles que já têm muito e já têm demais. E é mais uma vez por isso que a gente optou por ocupar esses espaços, para que a gente lá de dentro possa exercer a mesma pressão que a gente já exerce na rua, de fora para dentro. A gente quer abalar essa estrutura.
Eu tenho muita esperança, tenho muita fé em Deus que aqui a gente ainda vamos conseguir a nossa moradia digna, a nossa casinha para, ao menos nos últimos dias de vida, se vender numa casa.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York and London for our audience worldwide, good morning, good morning. The countdown to the open begins right now with equity futures holding on and bond yields breaking out. We begin with the big issue, COVID and the recovery. The US payrolls report coming in much weaker than expected as the surge in virus cases weighs on the labour market, giving economists plenty to worry about in December and beyond, fearing a setback as the pandemic continues its spread, accelerating across the United States. Another day of record-setting infections, another day filled with state officials urging caution.
The bottom line is if we don't act now, our hospital system will be overwhelmed. If we don't act now, we'll continue to see a death rate climb, more lives lost. And that's why today we are pursuant to the blueprint we put out some 14 or so weeks ago, pulling that emergency brake.
Governors finding increasing support on Capitol Hill with President-elect Joe Biden seeing the need for additional measures as well.
My inclination, Jake, is on the first day I'm inaugurated to say I'm going to ask the public for 100 days to mask. Just 100 days to mask. Not forever, 100 days.
While negotiations continue on the next stimulus package, a bipartisan proposal gaining momentum, increasingly gaining Republican interest as well. Senator Mitt Romney telling reporters, quote, "We're continuing to negotiate. We're getting more and more support from Republicans and Democrats." Senator Lindsey Graham backing the proposal, indicating the path to an agreement runs through the president. The country's commander-in-chief sounding optimistic.
I think they're getting very close, and I want it to happen, and I believe that they're getting very close to a deal. Yeah.
And you'll support it?
I will, absolutely.
Joining us now is Michael McKee, Bloomberg International Economics and Policy Correspondent. Good morning to you, Mike.
Good morning, John. Well, if you are looking for something from the economic data to stimulate stimulus, this is probably it. As you mentioned at the top, 245,000 jobs were created. That's only about half of what had been anticipated. It's the 7th straight month that we have seen job growth, but every month since the first time jobs started to rebound in May has been slower and slower. As companies go out of business, there just aren't jobs to go back to. The unemployment rate does fall to 6.7%. Part of that, though, because the participation rate is falling. Hold on to that thought. I'll come back to it in just a second. Lisa Abramowitz asked me earlier about what the real unemployment rate is. You take a look at the U6 rate, which includes discouraged workers, it's 12%. So almost double what we are in terms of the unemployment rate, the regular one everybody looks at. Here's kind of one of the stories of this number today, and that is retail hiring. This is the time of year when we add a lot of extra retail employees to help with the holiday sales. Didn't happen this time. Lost 35,000 jobs. You can see the little kink on the right-hand side of the screen there. That is not what was expected. However, I don't have it on this chart, but if you look deeper into the numbers, 82,000 people were hired as couriers and messengers. In other words, UPS and FedEx drivers. So we're going to see a real shift in the way the economy operates this holiday season. Finally, let me just show you this labor force total number, and this is what I meant by the participation rate. Even though we have seen a lot of people get jobs, and we've had 7 months in a row of expansion, we're still 10.7 million jobs below where we were in February, and we're seeing people drop out of the labor force because they can't find jobs. So the real unemployment rate doesn't even include the U6. The real unemployment rate still higher than that. We're not in a good place, and of course, November was the month when we started to see lockdowns, more and more coming now, John.
There's work to do. There is definitely work to do. Michael McKee, thank you, sir, as always. About 27 minutes away from the opening bell in the equity market. The story, though, is in the bond market. 2s, 10s, 30s, 10s and 30s, yields breaking out. On 10s, we are up by about 5 basis points. On 30s, we're up by 6. That curve is steeper. Treasuries are lower. Yields are higher. Off the back of the idea that a downside surprise in the payrolls report could be the stimulant to get the stimulus over the line down in Washington, D.C. I want to bring in Rick Reeder of BlackRock to continue this conversation off the back of the payrolls report. Rick, it's always fantastic to catch up with you on Payrolls Friday. Let's just start with your early take, Rick. What is it?
Thanks, Jonathan. So it was,
It's definitely weaker than anticipated, although I will say, the industry always has this a whisper number when you actually go through this because of adjustments, et cetera. That was actually lower than consensus. So this is not that far off the whisper number. But John, I think it says a couple of things. One, November was a tricky period. There were some retail adjustments in there that were going through. Clearly, there's some shutdown around COVID that was taking place, and probably you're going to see that work through, I would say, almost definitely into December. That being said, when you actually look at the income levels, they continue to be very solid. And listen, a lot of the jobs that are not coming back today because of this temporary dynamic are going to come back. The reason why, there are two reasons why the market's doing what it's doing. One is the anticipation that don't read too much into this, given the short-term influences we talked about, and that these jobs will come back. And I actually do believe that's right. And the second being this, as Michael said, this augurs for more stimulus, and that, maybe as early as the next couple of days, you'll see something along the lines of stimulus. So markets, I think, are rightly reacting to that.
So, Rick, this market will look through a soft print for November. Likely will look through a downside surprise, a soft print maybe for the month of December. Rick, when does it start to matter? If it goes to January, February, March, when do you think it starts to matter, if at all?
Yeah, it's a great question. So I think there's two parts to this. One, I think the economy and employment are different dynamics today, much more detached than they've been in the past, because I think what a lot of the economy is doing, a lot of what companies are doing is realizing you can operate more with a more virtual environment. And so you won't see the employment come back to where we were pre-pandemic. That's part of it. The other part of it, though, is I do think if we don't see it come back as vaccine starts to work its way through, yes, January is going to be important. February and March are going to be really important as you start to get vaccine implementation. I think you're going to see it. If you look at some of the key data in this report and recently, average work week keeps extending. What does that tell you? Companies are pressing on their existing labor force. Secondly, job openings are actually at almost 20-year highs, meaning there's just a lull in terms of bringing those people on. So that will come. But like you say, if it doesn't happen in the first quarter, then you start to wonder about that.
Well, let's sit on the Treasury market just for a moment, Rick. Yields are breaking out. The Fed meeting is a couple of weeks away. There is a belief out by many on Wall Street, some of your peers, who believe the Federal Reserve will extend the average maturity of the asset purchase program and put a cap on the other side of the screen. Rick, do you believe that they will? And how far would you push this move in Treasury yields?
So listen, it's tough to time it. Do I think the Fed is concerned about, or I don't know if they're deeply concerned about a few basis points move in the 10-year note. However, will they extend the weighted average maturity? Yes. Will they do it this meeting? Maybe. But yes, I think they are going to do some things that are going to be more accommodative, including, I think, ultimately you're going to shift the construct of the purchases into more treasuries. I do think they want to dull the higher rate dynamic. That being said, I do think as we get into next year, rates are going to migrate higher. I think the curve will steepen. And some of what's playing out is anticipation of what is a better economy, and that the Fed is going to put a brake on how much it moves. But the markets will reflect the fact you're going to get more treasury supply and the anticipation of a better economy. And quite frankly, that at some point the Fed will start to move. And inflation is moving up. We think moderately, but inflation is moving up.
It's an amazing dynamic. We're used to the idea that bad news could be good news for equity markets. For bad news to be bad news for the Treasury market is something new to me because of the stimulus conversation. Rick, let's talk about portfolio construction just briefly. What this conversation means for you on the bond side, and then we can talk about the equity side as another factor in all of this. On the bond side, what do you do?
I mean, Jonathan, it's coming into 2021. Cannot be any more different than coming in 2020. 2020, when you came into this prior year, you thought about, gosh, there's some yield in the Treasury market. I could build some balance using some long duration. Actually, the front end of the curve was really, I remember being on your show talking about the front end of the curve being really attractive to get some yield. It's all gone. So now what do? So now there are parts of where you try and get yield into your portfolio, places like emerging markets, places like credit, while spreads continue to ratchet in. I think every month we keep talking about this, but the demand for yield is going to be incredible. So hold a bit more cash in the portfolio, use a bit more equities in the portfolio than in balance funds where you can, and then get that yield. Parts of emerging markets, parts of high yield, parts of the loan market now are becoming interesting. And so try and get that yield. Securitized assets are interesting. Get more yield, hold more cash. And then the equity market is a better expression. Quite frankly, there's a lot of earnings and a lot of yield coming out of the equity market, particularly if you can sell call options against some of your equity position.
Rick, there's something that you guys have been talking about over at BlackRock that I think is fresh, it's interesting, and that's to build up the defensiveness on the equity side of the portfolio so you can build up the income on the fixed income side as you pull back from treasuries. Rick, can you speak to that a little bit? Because I think it's quite an important conversation for the next couple of years.
Yeah, I mean, it's something that's really powerful. I mean, there's not enough cash flow in the world, Jonathan. I mean, one of the things that we've been thinking about, talking about for a long time on your show, there's not enough income, not enough cash flow in an aging demographic. There just isn't. And some of it is because the technology has extinguished a lot of the frictional costs, which end up being cash flow. Think about energy is one part of that. So now what do? And you think about in the environment we're operating in, what the Fed has done, what the ECB has done is pull the discount rate down, get the rates to zero or lower than that. So now where do you get your cash flow? Where do you get your income? Gosh, the equity market earnings yields are over 4%. Free cash flow yield, which is pretty remarkable today, is still above 4%. By the way, earnings have recovered to pre-pandemic levels, which is also pretty amazing. But you can also sell things like options. So you look at some of these markets, the volatility is still high. And I think for months we've been talking about it on your show. You know, the equity market is higher, but volatility is still higher. So you can actually hold some equity, sell some calls against it, and create what is functionally an income surrogate in your portfolio, and it becomes more effective. And by the way, the assets go up as opposed to treasuries or agency mortgages today, where there's no convexity to the upside, and you're pressured by moderately higher inflation.
Rick, smart, sharp, always. Great to catch up, sir. My best to you and the team ahead of Christmas if we don't catch up. Rick Reeder, always fantastic. Thank you, sir. Looking at this bond market right now, your yield, 0.96%. The high on the session, 0.9692%. The high of the year, we are just a whisker below it at 0.973. I say the high of the year, the high post-pandemic shock. Post-pandemic shock, not quite the high of the year. Keep an eye on this bond market breakout of the last hour or so. At the market desk with your movers, here's Abigail.
John, ahead of taking a look at U.S. movers, we do have some breaking news here on Glencore, the Anglo-Swiss mining and metals and commodities company. Shares are higher, up more than 1%, holding the day's gains on the news that the CEO, Ivan Glasenberg, is retiring. He will be replaced by Gary Nagel, and this change will happen over the next 6 months. And you can see Glencore holding the day's gains, although off the highs. Turning to U.S. movers, having to do with the hopes for stimulus based on that less than perfect jobs report. We do have the reflation trade in place. American Airlines up 2.4%, despite the fact that they're saying that they're seeing slowing bookings and daily cash burn at the high end of the range. Traders probably considering the idea that stimulus could come through and help. The same deal with Carnival. We also have ExxonMobil trading higher, up 1.8%, in line or ahead of, better than oil, but in sympathy with oil. And the bank's getting a nice boost from the yield curve up, the 2-10 spread up about 4 basis points. As you know, where is money coming out of? Tech. It's a little bit mixed, actually. We have small gains and moves for the likes of Apple, Microsoft, and Facebook. So very much today, that reflation reopening trade, John.
Abigail, thank you. The opening bell is 18 minutes away. It's a downside surprise on the payrolls report. What it takes to get fiscal talks wrapped up down in Washington, D.C. That conversation up next with Mike Collins of PGIM. This is Bloomberg.
a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
The first day I'm inaugurated to say I'm going to ask the public for 100 days to mask. Just 100 days to mask. Not forever, 100 days. And I think we'll see a significant reduction if we occur that, if that occurs with vaccinations and masking to drive down the numbers considerably.
President-elect Joe Biden discussing potential plans for tackling the pandemic, hoping to slow the spread following another day of record infections in the United States. New cases surging amid tightening restrictions, forcing state officials to implement even tighter, stricter measures. Delaware issuing a stay-at-home advisory. Ohio's governor telling residents not to travel within their own state. All of that fueling the prospects of a stimulus package down on Capitol Hill. Republicans beginning to show support for a $908 billion bipartisan proposal. Bloomberg chief Washington correspondent Kevin Cerruti joins us now with the latest. Morning, Kevin.
Good morning. Two things on my radar today, specifically as it relates to fiscal stimulus talks here in Washington, D.C. The first is that Senate Majority Leader Mitch McConnell unveiling a separate proposal of his own that he's been working on with top Republican leadership in the Senate, and the President Trump, saying that he is going to be backing that. This, according to new comments made within the last couple of hours from Treasury Secretary Steven Mnuchin. It's a negotiation tactic of sorts, which is the second point that I'll make here, because Democrats, looking at the new dynamics of the upcoming math in the House of Representatives, where Republicans were able to make gains, are feeling essentially that centrist Republicans and Democrats might have more political capital in the new Congress. It's caused Speaker Pelosi to significantly lower that $2.4 trillion price tag down to $908 billion. Now, aides to some of the top Republican senators have told me over the last couple of days that they're ready to get on board with this $908 billion package. In public comments from everyone, including Senator Richard Shelby, John Thune, Mitt Romney, Susan Collins, all showing a willingness to get on board with this. The vote, Jonathan, could actually come sometime within the next couple of days.
This market getting behind that idea very quickly off the back of that downside surprise on a payrolls report. Kevin, thank you. Does that really move the dial down in Washington? One downside surprise on a payrolls report. Maybe that's the take right now. Just look at the bond market. Yields out towards the post-pandemic shock highs of the last several months in the Treasury market. In the FX market, dollar weaker, euro dollar 121.60, just off the highs for the year. Cable breaking out to levels we have not seen since 2018. There is, of course, a Brexit twist, a Brexit angle to this conversation. Pound sterling 135.22, up by about 0.5% on the session so far. Sterling with a 135 handle. That's the story in the market at the moment. PGIM's Michael Collins remaining optimistic on the outlook for 2021. He says the following: despite the big drawdown in the first half, global GDP is only going to decline 2 to 3%. Equity markets will be flattish or post positive returns across the globe. The bond markets will see significant gains. Michael Collins joins us now for more. Mike, great to catch up. Payrolls, about 50 minutes old. Your take, please.
Yeah, Jonathan, obviously they were a little weaker than expected, but, you know, the average hourly earnings were pretty strong. The thing we're really focused on in our shop this morning is the labor force participation rate. And I know you and Mike McKee have been talking about that a lot this morning. People are dropping out, right? And, you know, economists like to talk about the scarring, kind of the permanent impacts that this pandemic will have on the potential growth rate of the economy. And we're worried that once you get through this big pop in growth in the middle of next year, you might just revert back to where we've been, which is kind of this really sluggish global growth outlook going forward, which is one reason we really like long U.S. interest rates at these much higher levels.
So you like the 30-year, the 10-year, where they are right now, Mike?
Yes, absolutely. We think this kind of backup in rates, Jonathan, is really a gift that the market is giving us. And one way we gauge the value there, and I think people miss this all the time, right? I mean, the bond market is very forward looking. If you look at a 10-year today, it's, you know, right where it is, 95 basis points. And as you know, our range on that 10-year has been between 0.5% and 1%. And our view at PGIM Fixed Income is we're going to generally hold that range because the curve is so steep, right? Even though that 10-year is only 1%, the 30-year is getting close to 2%. And if you look at what's priced into that 10-year note, in 10 years from now, it's well over 2% now, and that's kind of a flashpoint for us. That's a point that definitely marks value because relative to the yields around the rest of the world, man, that is a really big number, and we do not think we're going to have a 10-year note above 10% in the next 10 years. So there's already value being created in the bond market.
Mike, where does that leave your credit call at the moment?
Well, we like credit a lot better. I do not want to overstate our view on rates because generally we have a massive underweight in U.S. Treasuries, right? It's just that we like the overall level of U.S. interest rates, but the real value is out on the curve in credit, right? If you look at that 30-year bond, Jonathan, at 170, the average spread on 30-year corporates that we own are kind of about 170. So that gives you a yield of 3.4%. on the 30-year kind of BBB rated corporate bond. And we think the curve is attractive out there and the spreads are attractive out there. So you can actually have pretty significant total returns over the next year or two by investing in the right bonds in that part of the curve. But it really is a credit story, Jonathan. You do not want to own treasuries here. You do not want to own cash. You want to own a variety pack of credit, and that's where the outperformance is going to be for sure.
Well, let's talk about credit selection then, Mike. I caught up with your colleague, good friend of ours, Greg Peters, earlier this week. Triple C's tighter now than they were before the pandemic. That's the junkiest of junk. Where are you looking for that total return? Where'd you get it?
Yeah, so the median Triple C is tighter than where it was. Obviously, the Triple C part, the risky part of the high-yield market, always has this huge tail to it, right? This really risky tail. And if you kind of strip that out, you're absolutely right. The median is actually a little bit tighter. But, you know, we actually like the kind of the BBB, BB sweet spot. I know Greg Peters has talked about that on your show, and that's where we see a lot of value, right? When you're a BBB rated investment grade company, you do not want to get downgraded to junk by and large. It gets really expensive to finance all that debt. So they do everything they can to hold on to that rating, and they pay down debt over the next few years, which is where the deleveraging really works for you as a bondholder.
Hey, Mike, always brilliant to catch up. Let's catch up before the year is out. Mike Collins there of PGIM. Thank you, sir. Coming up on this program, the analyst action you need to know. That'll be next in our morning calls. Then, much more on the conversation after a downside surprise on a payrolls report, what it means for fiscal stimulus talks and the year ahead. Anastasia Amoroso of JP Morgan joining us shortly. In this market at the moment, equities holding on. This bond market, these yields breaking out. Your 10-year, 0.96%. Just a basis point or so away from the post-pandemic highs on a 10-year Treasury yield. For our audience worldwide, the conversation continues on this Payrolls Friday. This is Bloomberg.
सिर्फ और सिर्फ इस इलाके में ड्रिप इरिगेशन सिस्टम की वजह से है और इससे हमारा मुस्तकबिल भी और इससे हम फ़ायदा भी ले रहे हैं।
तकरीबन 20,000 स्क्वायर किलोमीटर लैंड जो है वो अबंडेंट पड़ी है, जिस पे कुछ भी एग्रीकल्चर टेक्निकल तरीके से नहीं हो रही।
5 minutes away from the opening bell in New York City. For our audience worldwide, 55 minutes ago, a downside surprise on a payrolls report does nothing to this equity market. Up 10 points to the S&P 500. We advance 1/3 of 1%. That's the story for stocks. Here are your morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Guggenheim downgrading Dish Networks to neutral with a $53 price target. The analysts seeing limited upside with increasing headwinds stemming from the wireless industry. That stock is negative 1.4%. Next up, Wolfe Research downgrading Boeing to underperform your price target. They don't have one. The analyst noting that the stock is pricing in a recovery scenario that appears to be overly optimistic. We're softer there by 0.5%. And your third and final call comes from Wedbush, raising its price target on Starbucks to 101. They have an outperform rating. The analyst expecting a notable jump in U.S. sales growth following recent channel checks. That stock is positive by 1.54%. That's three of the calls. Up next, following today's disappointing payrolls report, what it could mean for the future of the reflation trade and the fiscal conversation. JP Morgan's Anastasia Amoroso joining us shortly, and later I'll be catching up with the National Economic Council Director Larry Kudlow for reaction from the White House. All still ahead right here on Bloomberg TV.
Swells the gap between the rich and poor around the world. There may be no starker case of inequality than Venezuela, where the socialist leader Nicolás Maduro has kept his hold on power by fostering a Darwinian dollarization under quarantine. The nation's mighty oil industry has collapsed. Water, electricity, and gasoline are barely available, and hunger hunts vast portions of the population. 4 out of 5 Venezuelans can't afford a basic food basket last year, according to a research by the main universities. Meanwhile, Caracas neighborhoods have a dozen new delivery services bringing to their doors everything from truffle salmon poke bowls to electronic cigarettes and $50 gluten-free birthday cakes.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Do you long for the slightly more intuitive days when good news was good news and bad news was bad news, or are you comfortable with the era of good news is good news and bad news is good news too? It's the story at the moment. Downside surprise on payrolls. We're negative below the 4060 number. 460 was the estimate, 245 positive. Just make sure we're clear in case you missed that number. 245 was the number, 460 was the estimate. Equities up by 8 points to the S&P 500 by 0.25%. That's the story for stocks. For bonds, bad news is bad news. Treasuries, lower yields higher, up 5 basis points to 0.9592%. In the FX market, dollar weaker, euro dollar 121.58. Cable breaking out. We'll touch on that a little bit later. And crude up by 1/3 to $45 and about 76 cents. That's the cross-asset story at the open. Here's Katie Greifeld at the market desk for more. Hey, Katie.
Hey, John. Well, one place where bad news is on the earnings front. Ulta Beauty missed on revenue last quarter. It was down 7.8% year to date, and it also withdrew first quarter guidance in another warning sign over rising COVID cases. Marvel also down about 2% after only matching EPS estimates and warning on supply chain issues. Big Lots also in the red, as you can see. It beat EPS estimates by a dime, but it warned that its strong start to this quarter might not last, again, as virus risks continue to rise. Now, one bright spot in markets, here we are, we're red, Smith & Wesson. It's now lower, even though sales surged 61% last quarter, and the company sold a record amount of firearms during the election season. Now, retailers may be worried about COVID cases on earnings calls, but evidently investors in travel stocks aren't as fussed. If you look at Delta, American Airlines, both higher this morning as trading kicks off. Southwest is also up as optimism continues to build around stimulus talks. You can see Carnival is also rallying after updating guests on its plans to resume trips in 2021. So clearly that reopening trade is still working this morning, John.
Katie, thank you very much. That's the story with the movers at the opening bell. About 2 minutes into the session, we advanced 0.2% on the S&P 500. On top, energy, we advanced there by 2%. At the bottom of the pile, healthcare, negative about 0.1%. That's the story of the equity market. For all of us worldwide, stimulus hopes and vaccine optimism fueling inflation expectations, sparking a rally in the reflation trade. Chris Harvey of Wells Fargo weighing in.
You have a recovery and you have a multi-quarter, multi-year reinflation trade or steepening. And that's very positive for financials. That's very positive for small caps. That's very positive for the economy. A lot of people are piling into the momentum trade, but we think we're in the final days of that momentum trade. You really want to be a contrarian. The opportunities are more on the side of being a contrarian and things that haven't been picked over at this juncture.
For more, let's bring in Bloomberg's Abigail Doolittle. Hey, Abigail.
Hi there, John. Well, in terms of the reflation trade, that really is the theme of 2020, but in different waves. If we go back to March, when we were in the dark depths of stocks really crashing around the pandemic, not knowing what's next, then the Fed came in with all of their liquidity. On that, stocks really took off. The all-world index there in blue up about 40%. We also have the bond index, aggregate bond index trading higher. So stocks, copper also doing very well right out of March. Not doing so well, the Fed liquidity weighing on the dollar. The dollar right now down about 6% on the year, heading to its worst year since 2017. But that weak dollar really helping all these risk assets climb. Now that's been reemerging more recently. Over the last 3 weeks, John, the dollar is down. That has helped out commodities over the last 2 weeks. We have the likes of oil, platinum, copper, iron, all trading higher over these last 2 weeks. Big gains for these illiquid risk assets traders want in. And of course, the question is about the next Fed meeting on December 16th. Many consider it to be a live meeting. What will happen? Will they provide more stimulus? Certainly, perhaps keep the idea that they are there ready to do whatever it takes. In addition to the hope for fiscal stimulus, John, on the Fed, we do have the 2-10 yield curve spread really steepening, its highest level since October 2017, helping the banks, travel stocks, stocks in general on the idea, the nod toward inflation, even if it's not quite there yet in the real world, John.
Treasury yields breaking out off the back of that payrolls report, which was a downside surprise. The argument pretty clear for the last hour or so. Many people believe that is the nudge to get them over the line down in Washington, D.C. J.P. Morgan's Anastasia Amoroso identifying opportunities within the reflation trade. She goes on to say the following: investors should look for real assets that outperform when inflation is rising from lower levels. These could be opportunities in equities, property, infrastructure, and commodities. Investors should position for a steeper yield curve. We have that steeper yield curve this morning, and Anastasia joins us now for more. Anastasia, great to catch up. The difficulty for so many people through this year is to embrace this recovery, given everything going on around us. How do you do that?
Jonathan, I think we have to do it. We have to acknowledge that year of 2020 has been the year of the virus. It's been the year of all the pandemic challenges. And next year, 2021, is going to be the year of the recovery. We have 4 vaccines that are likely to help us get to mass-scale vaccinations, hopefully sometime by the middle of next year. So if that's the case, then what we're likely to see is a much broader economic recovery than we've had to date. I mean, it is great that the unemployment rate today is down to 6.7%, but everybody knows that this has not been an even recovery across sectors. So what we look forward to next year is a more broadening economic recovery that can in turn lead to higher inflation expectations, and that's part of the reason why you see some of those bond yields rising. So how you do that exactly, I think the reopening trade that you were talking about is very much on the table. And I do agree that a lot of the stay-at-home momentum stocks have had a wonderful performance, wonderful rally this year, but they have seen some of that performance stall a little bit here. And I think the handoff going into next year is going to be to the continuation of the reopening trade. Reopening trade, especially in the real asset side that has the ability to experience rate increases. Because if next year we're in a situation where bond yields are rising, however modestly, you don't want to be in bond proxies. You certainly don't want to be in U.S. Treasuries. You want to be in assets that are starting from depressed levels of valuation, but where you have some opportunity for income growth. And of course, it's pockets of real estate and it's pockets of infrastructure as well.
Let's unpack that a little bit. The lockdown stocks, the reopening stocks, and try and draw a firmer, harder distinction between the two. A lockdown stock could be Clorox, quite clearly an advantage, a winner from lockdowns, trapped in our home, cleaning everything. When we reopen, things get back to normal. I imagine they'll suffer. Then reopening, Macy's had a massive month last month. Kind of makes sense. Footfall, traffic starts to pick up again. People start shopping again. I get that. But Amazon's somewhere in between. It lives in both worlds. Can still have success. How do you draw that distinction between what does well and what won't?
Yeah, what I was referring to specifically are some of the tech darlings, the stay-at-home darlings that have done so well. If you think about the behavioral adaptation that we've made this year, it is work from home, it is work out from home, it is buy anything from home and have it delivered to you. So if you look at the tech performance, it's interesting because the tech sector has continued to move higher, but you have seen some stalling in performance in the tech names that you mentioned that are tied to the stay-at-home trade. So the reason why I single those out specifically versus the Clorox is because when you look at the valuations of some of those names that are starting to be a little bit stretched, especially in the large cap space. So I think some rotation is in order there. On the flip side, when you look at the reopening stocks, there's 3 categories of reopening stocks that we look at, which is the mobility, banks, and REITs. And if you look at the mobility category, airlines, hotels, cruise lines, and ride-share services, which is quite interesting for us, we've seen a collapse in mobility in the last month. We've seen it in the U.S., we've seen it in Europe. As 2021 progresses and that mobility metrics start to pick up, we would expect those stocks to do well. And clearly some of them maybe help with the fiscal stimulus as well. Banks, they've had a stellar quarter so far, and I think that bank performance can continue. They're still down year to date. It is the cheapest sector in the S&P 500, and the steeper yield curve certainly helps there. And then there's REITs, which is a bit of a mixed bag, because you've got some REITs, like the warehousing REITs, that have done phenomenally well. Their cap rate's around 4%, so pretty full valuations there, but they're still benefiting. And then the other side, you have something like apartment REITs that are actually in the public markets trading below what we think might be the fair value of their underlying real estate. And by the way, the rent collection rates are still in the 90% range, 95%. So these are, I think, kind of diamond in the rough assets, undervalued assets that could see their performance improve next year.
Before we go, let's get into dangerous territory. Would you consider leverage?
We would consider adding leverage for select lines where it makes sense. And the reason I say this, because we expect that the Fed is not going to do much in terms of higher rates for a long, long period of time. So rates are pegged at 0. And at the same time, we've seen a collapse in yields across the fixed income curve. However, looking at high yield, looking at high quality emerging market credit, you still have a pretty decent yield there. But if you could add a turn of leverage, you could just potentially boost that yield by 1.5 to 2 percentage points. So I think carefully and selectively we would consider it. Be very careful with the credits to which you add leverage. But in this environment of economic recovery into next year and the Fed at zero, that does make sense to us.
Anastasia, great to catch up with you. Let's catch up soon for sure. Anastasia Amoroso there of JP Morgan Asset Management. In this market right now, bond yields breaking out, the curve steeper. Your 10-year up by about 5 basis points. Your 30-year travels north by 6 basis points. And your financials start to do well off the back of that. With more, here's Abigail.
John, well, you just described a reflation trade right there, and that is indeed what is happening on the day. As you know, energy and financials, top sectors on the day. The top stocks for the S&P 500 right now, JP Morgan and ExxonMobil. Let's also take a look at Chevron. We see nice gains here. The banks, of course, gaining on the yield curve steepening along the lines of what you were just talking about. Oil up modestly. It's enough for energy to rise. On the other hand, you have those stay-at-home stocks, this year's defense, the big momentum stocks, Apple and Alphabet taking a bit of a breather. Not a huge sell-off, but they are taking a breather. On the week, we have some interesting movers, a little bit of both. The best stock on the week for the S&P 500 is Carnival. So that is certainly the reopening trade, the hopes that this company is going to be cruising again, as they say, in 2021. Micron, however, technology stock, also top stock on the week after they basically pre-announced the upside. To the downside, energy this week, John, taking a little bit of a breather, but that's just because it's had such a big week the week before. So really not true selling there. And then Salesforce.com, of course, that is the worst stock for the S&P 500, a tech stock. That weakness comes on the announcement of their acquiring Slack, John.
Abigail, thank you. You'd have to pay me a lot of money to be trapped on a boat with the same people for a month. That's just my view. Not worth much, I know. Coming up, a disappointing payrolls report and the expectation that we get more fiscal stimulus down in Washington, D.C. On that, Jim Bianco of Bianco Research. He joins us very shortly right here on Bloomberg. This is Bloomberg TV.
Welcome to That's Debatable, an interactive series on today's most pressing issues. This week's resolution, should we stop worrying about national deficits? We'll hear from both sides.
Every deficit is good for someone.
There will be automatic spending cuts if nothing is done.
And we'll get your perspective, too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
So the reason we're interested in Post Office Rock is just the extreme nature of the erosion that is ongoing here. In the last, well, since 1940, it's eroded about 100 meters and in quite a unique fashion. By having a map of the seafloor and hopefully being able to capture some movement in these transverse dunes, we'll be able to see after the erosion where the sand is going and why it is not replenishing the coast as sometimes and most often happens.
With continued sea level rise and future climate change, we're just going to see much more of this kind of event taking place. So it's a good proxy of what we expect to take place much more commonly by 2050, 2100 than is currently the case.
think it really is very important for the Fed that they do see what's coming through in terms of fiscal stimulus. That will be a key factor in their decision-making process. In addition, obviously we will hear about whether they propose to taper. We'll hear a lot more about their forward guidance. We will hear, hopefully, something about the weighted average maturity of the QE program. So there's a lot for the Fed to digest.
There is a lot for the Fed to digest, including a decelerating labour market. That was BlackRock's Marilyn Watson expecting stimulus talks to dictate the Fed's next move amid further signs that the pandemic is weighing on the recovery, with US payrolls falling well short of estimates this morning. For more on that, I want to bring back in Mike McKee. Hey, Mike.
John, kind of the question for the Fed is, what can they do and why should they do it? When you take a look at what the issues are for them, the known unknowns, as you might say, there are three major things that they're not going to really have a good handle on at the December 16th meeting. One is the long, dark winter of COVID. How bad does it get, and how soon do we get the vaccines distributed? The second is the status of the fiscal stimulus. Maybe we'll have a package by then, maybe not. Hard to tell, and we don't know exactly what the impact will be because we don't know what's in it. And then the performance of the economy. As you mentioned, we did see a slowdown in hiring this month, but what happens to retail sales? Are people still spending money? Are they spending their savings? Where is the economy going? When you look at what the Fed is expected to do in the markets, the folks at BMO do a survey before payrolls, and about 45% think that the Fed will stand pat. And you can see that in the market pricing for Fed funds. When you look at the dots go chart that we have on the Bloomberg that reflects the dots that are put out by the Fed, you can see the orange line there is the option indicated spread for what they think interest rates will be. And it doesn't really start to move until the end of 2021. So nobody really thinking the Fed is going to do a lot coming up now in terms of any kind of stimulus. And finally, the question is, what do they do if they want to do something? And that gets back to the same thing that Marilyn Watson was talking about, the weighted average maturity. They've been buying at the short end, and you can see the maturities there. Do they push that out to the longer end to try to push down on long rates? That may depend on where we are when we get to the 16th. If there's a stimulus package, you've seen rates rising. Do they continue to rise? If there's not, do they fall? A lot of questions for the Fed. No clear answers as to what they could or should do.
No clear answers at all. I think this comes down to expectations, Mike, on what people expect in a couple of weeks and whether the Fed meets them or not. Mike, thanks. Jim Bianco of Bianco Research cautioning the Fed to tread lightly when adjusting their policy approach. He writes the following: the Fed should be very careful in changing the program, like extending maturity, which is a popular call. Fed programs are forever. Jim joins us now for more. Jim, expand on that. Why do you think they should be so careful?
Well, Fed programs are forever. Remember, QE was started as an emergency program during the financial crisis in 2008. 12 years later, it's bigger and better than ever before. The big story of the last month was the shock that the temporary bond buying programs were indeed temporary, and they're going to end on December 31st. If the Fed were to expand and buy longer-term bonds, they have to say to themselves, this is going to be forever. We saw what happened in 2018 when they tried to reduce the balance sheet on automatic pilot and the market threw a hissy fit. They're going to have a hard time getting out of this. So if they do decide to buy bonds and something like inflation or higher yields or concerns come that the Fed needs to raise rates, it's going to be very, very difficult for them to reverse that policy somewhere down the road. So use it when you have to, and that would mean maybe when you get into another uncertain market environment like we were in the spring, but don't be running it out there just because you feel like you should. You might regret it.
Jim, from a policy perspective, do you see the positives in a steeper curve in higher yields at the long end?
It depends on why you're getting higher yields. Interest rates typically go up because of expected nominal growth. Nominal is real growth in inflation. If the reason rates are going up is real growth is expanding and the curve is steepening, that's good. If the reason is because inflation expectations are expanding, excuse me, that's not good. So it's not just a case of higher yields are always better. I know that's been the case for the last 25 years, but if it is the case like Bill Dudley wrote yesterday or the day before on Bloomberg that we might be seeing inflation, then higher yields are not necessarily the panacea that everybody thinks they're going to be, because if they come on the back of inflation, that could cause all kind of problems.
Jim, you've been quite critical of the Federal Reserve's response at times through 2020. You haven't hidden that. You've come on this program and shared it with me. Jim, when do you think we pay the bill, and what is the bill? What does it look like in the years to come?
I think the bill is going to be inflation. If you have all of this, these purchases, the expansion of the Federal Reserve's balance sheet, add in the massive $3.2 trillion deficit, which is one of the highest debt to GDPs ever in American history, that all of that should lead to inflation. That's why we've never done it before in American history, because whenever you've had this kind of massive government and monetary response, it's always led to too much inflation. If it doesn't lead to inflation, I always like to talk about the other side, well, then let's just send a check to everybody every week, because if there's no consequence to doing this, there's no reason to stop it. But I do think there will be a consequence, and that consequence very well could be in 21 and into 22. We're going to start to see significantly higher inflation, and for the equity market, that might lead to multiple contraction.
Jim, just quickly before we let me go, in a couple of minutes' time, I'll catch up with Larry Kudlow, a man you know well. What do you think is left for this administration to do in the month and change that they have in the White House?
Probably get a fiscal deal done at this point. That is the most important economic story that Larry would have to have, is where are they with the fiscal deal, and what type of deal would it be?
Looking forward to catching up with Larry Kudlow in just a couple of minutes' time. Jim, great to catch up, sir. We'll talk before Christmas. Jim Bianco there of Bianco Research, thank you. With your sector price action, let's bring back in Bloomberg's Abigail Doolittle.
John, well, it is shaping up to be a risk-on Friday and a risk-on week. The S&P 500 headed to a second up week in a row, up about 1% currently on the week. Now, relative to today in the sectors, most or all sectors are trading higher, utilities flipping between small gains and losses. But up top, it is all about the reflation reopening trade that you've been dissecting this morning. Energy, materials, real estate, industrials, financials, those are the best sectors. Energy, once again, soaring up 3.2%. And this is the story of the fourth quarter. If we take a look at what's happening in the fourth quarter, the best sectors, energy up more than 30%, financials up 20%, and the industrials up 15%. Risk on toward reflation. Those cyclical sectors certainly getting a bid this quarter, with oil rising, the dollar down, and of course the yield curve steepening, John.
What a couple of months it's been. Abigail, thank you. Coming up, the market-moving events you need to be watching into next week. We'll bring you the trading diary. And still ahead, National Economic Council Director Larry Kudlow. In your market right now, bond yields breaking out, equities holding on. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
25 minutes into the session in New York City, equities up by about 1% on the Russell, on the S&P up by 0.4%. New all-time highs in sight at the close this Friday. Let's get you the trading diary, what you need to be watching through the day and into next week. President-elect Joe Biden delivering remarks on the jobs report this afternoon. President Donald Trump holding a rally in Georgia for the two Republican senators facing runoff elections there on January 5th. On Tuesday, Trump hosting a coronavirus vaccine summit. Thursday, we get an ECB rate decision and President Christine Lagarde holding a news conference. Then through to the end of the week, another round of jobless claims on Thursday morning, CPI data and the Treasury budget statement. That does it for me about 26 minutes into this session. Equities advance, Treasury yields breakout in just a moment right here on Bloomberg TV and radio. We'll get you the White House reaction to that payrolls report. Larry Kudlow just around the corner. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque
swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here. but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting